We just can't catch up after going through a depressionary bust with this health crisis to suddenly having a runaway bull market.
We know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change? We're all becoming behavioral scientists.
The real question is, beyond the summer, after we get this reopening-driven boost, how long is this going to sustain itself?
All eyes really are on what constitutes substantial progress right now.
What's this economy look like 6 months, a year down the road? And that's where I think you're going to see this real inflation, and it's going to be more persistent than people are currently pricing in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From New York City, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures this morning totally unchanged on the S&P 500. Here are the words of Morgan Stanley. Dreaming of reopening is easier than actually doing it.
Yeah.
Tom Keene, execution risk front and center.
Nice phrase, and it really buttresses up against some of the trends we're seeing this week. I know we go into earnings, John. You're going to talk Tesla and Microsoft today, but it also is a boom economy really punched up against interesting logistics. Just moments ago, palladium out to a record high. Some of these commodities go away. We're on, Joe Weisenthal mentions, John, we're on 10,000 watch on the LME on copper. I mean, there's some interesting supply-demand constraints within this boom economy.
The demand is good. Can supply meet it? And I think we got a flavour of that issue from Elon Musk and Tesla yesterday with the chip shortage. It wasn't a huge issue for them. It could be a big issue for other auto manufacturers too. And that's going to be the story, I think, for the weeks and months to come. A lot of people are focused on that. Big expectations. Can we meet those expectations with supply?
I don't suggest, John, that we're going to see commodities pop into the inflation watch. There's, some people saying really an ebb in the inflation worries. But what I would say, John, is on a Tuesday, it's a stew of information, and we're dying to get some clarity out of this. We don't have it.
Well, here's some clarity from UPS, Lisa. First quarter adjusted EPS 277. The estimate 173. It's just one more beat in a big line of beats.
What's interesting, though, is a big line of beats, and markets are shrugging off all of those beats. Even Tesla's record quarter and the fact that they sidestepped some of the chip shortage issues, people are shrugging. The expectations are so high, which goes back, frankly, John, to that quote in UBS, which is the dream of reopening is perhaps easier to price in than the reality, which is fraught with all of these frictions which are coming to the fore.
Morgan Stanley. Mike Wilson will be unhappy. That was a Morgan Stanley quote. We'll get to UBS in a moment. Do you want to talk about UBS right now?
Sure.
What is material? What is material these days? If it's not $800 million.
$861 million.
What is material these days?
Yeah, and why did they not reveal the fact that they did have losses tied to the Archegos hit? And that's the reason why their shares are suffering as a result. What are people missing in terms of risk management, John? And that, I think, has been what's hitting Nomura as well as Credit Suisse.
What's your take on that, TK? Nomura, $2.3 billion. Credit Suisse, a combined hit of $5.5 billion. Morgan Stanley, almost $1 billion. Not material. UBS, $774 for this quarter. $774 million, not material. Is this in the context of how earnings looked, what the earnings profile was for that quarter? Is it relative to what your competitors lost? I don't get it anymore.
Here's the way it works. You do leverage, and you're successful. So you do it again, and you leverage up further, and you do it again. I would suggest that the leverage up by these firms, their exposure, if you will, to a family office, come on, it's a hedge fund. Their exposure to it, John, was very simply once successful, twice successful, 3, 4, 5 times, boom, and then you're not. And you see that constantly when you study failed hedges. I would go to gold mining hedges as one of the examples of that.
Tom, don't you think it's a bit rich, though, if a bank comes out and says we weren't required to disclose the hit until we reported the earnings this morning?
That's a cultural
thing. At the same time, follow up by saying we need more disclosure from clients.
Yeah.
How would you feel as a shareholder about that? They want more disclosure from the clients, but they're not willing to disclose things like this ahead of time.
One of the little secrets, John, of this business is how corporations vary in their tone to shareholders. And you see it. You've seen it with this Archegos the mess.
Some of this has been a bit tone deaf. Here's the price action this Tuesday morning. Good morning to you all. We're shaping up as follows. In the equity market, there is none. Equity futures unchanged, 41.78 on the S&P 500. Call it 41.79. Euro dollar 120.69. Euro dollar coming in a little more than 0.1%. And in the bond market, yields higher by a basis point to 157.74. Do we call it a snooze fest, Lisa, as we kick off a Fed meeting down in D.C.?
Never. I would never call call it a snooze fest. I'll leave that to others who do that frequently. And I will say, frankly, there's not a lot of action in markets, but there's a lot of action in Washington, D.C. And frankly, that's where my focus is right now. 1:15 p.m., President Biden is going to be making some comments on the COVID response in the United States. People are expecting him to come out with new guidance from the CDC saying that if you've been vaccinated, you don't have to wear a mask outdoors. Potentially, even people who are unvaccinated might not have to wear masks outdoors to the same degree. Also possibly giving some indications of what the U.S. aid may be to India and other hard-hit places around the world. This is another thing I'm watching down in Washington, D.C. 2:30 p.m., a Senate Finance Subcommittee is holding a hearing on a fairer tax system. This is a Senator Warren special, and she's having a number of people testify, not among them Leon Cooperman, who actually rejected her ask to come join. But this, to me, will be interesting to see how much Democrats are united on raising taxes. We're hearing about the capital gains taxes on individuals or couples making more than $1 million, as well as tax hikes elsewhere. And then today, we're also going to be getting after the bell that roll of earnings, including Microsoft. A lot of people will be looking at their Azure cloud computing unit in particular, as well as Alphabet. Key look at how much advertising revenue picked up, given the fact that people are actually moving around more. And perhaps there's a little more to advertise, given that the world is opening up a bit.
Yeah, Lisa, I'm glad you mentioned Google. They sometimes fly under the radar here, but it'll be interesting to see. I refuse to call them Alphabet, which is maybe as dumb as Aberdeen. Let's do our last Aberdeen banner here, you know, off of Alphabet. I guess I could do that as well. We're comparing UBS with UPS. And well, John, there's thank you. There's one banner, John, for PS I want to talk about, which is United Parcel Service not providing 2021 revenue and earnings guidance. That, to me, John, is a little bit of surprise and maybe is a little bit of a tone of the American uncertainty on Q3, Q4.
Things will be good. Just how good? Maybe that's where the uncertainty
lies
right now.
No-vol banner, John. That's it.
Thank you, Tom. Coming down from D.C., here's some news for you. President Joe Biden will require federal contractors to pay workers at least $15 an hour in an executive order designed to leverage government purchasing power to boost working conditions for low earners. The reporting coming from Ben Penn this morning ahead of that executive order. So, Tom, this is it, isn't it? This is the moment where we start to talk about higher labour unit costs, etc. Bank of America put out some nice research. Savita Subramaniam leading that team. The number of mentions of inflation on earnings call year on year have tripled. It's the biggest jump going back to 2004 when they started tracking the data. Tom, we're talking about raw materials, transportation, labour, all cited as major drivers of inflation, and many plan or already have raised prices to pass through to higher costs. That has got to be the number one issue in the coming quarters.
No question on the conference calls. And John, what's so important there is it reversion up to the mean, or do you go through the mean up to a truly greater inflation? And that's where the debate begins.
Let's bring in Jennifer Lee, shall we? BMO Capital Markets senior economist. Jen, can we start right there, just on how you're reading some of the corporate guidance around cost pressures, around the labour market?
Oh, good morning, everyone. So this is where, as you're all saying, the uncertainty is lying. How much inflation is really being built up through the system? Like if we were talking about this, like, say, 9 months ago, you know, a lot of people were saying that inflation is going to be very slow to come back. But we all know that at some point, when things open up, and they are opening up clearly, as difficult as some companies are having it, but they are opening up, price pressures are starting to rise. And this is why I'm always interested in watching things like the ISM surveys. Data are obviously clearly important, but what people are saying, what companies are saying out on the ground is very key. So again, one of the ISM surveys, like the manufacturing one that have always been talking about with the respondents, have always been referring to higher price pressures and finding how labor is difficult to come by these days, and they're paying more for wages and all that. So those sorts of comments, what companies are saying, I think is very critical to the inflation outlook, and we do see inflation perking higher in the months ahead.
Do you model in wage inflation as part of that new inflation?
We do. I mean, wage inflation is obviously part of the entire inflation picture, not just goods and services, which are also on the rise. But with labor shortages and people or companies struggling to meet this newfound demand, they need people to create these, to create these widgets, to be on the factory floor, for example, to be at the restaurant floor. And so in order to get more people, obviously they're going to have to start hiking wages and bringing in and introducing more benefits to lure people back into the labor force.
Does it still feel transitory, Jennifer?
A little bit, yes, because we're not all the way there yet. This pandemic is still, front and foremost on everyone's minds and everywhere in the world. So things are moving forward, but obviously it's going to depend on which area, which country we're talking about. In the U.S. Has been at the forefront and has been moving forward very quickly thanks to the fast pace of vaccinations. The UK as well. So things are opening up. So it's looking better. It's definitely looking a lot better this year. And then you have other countries who are not. Who are still struggling on vaccinations, like in Europe and in India, of course, and that's where things are still, I don't think we're transitory yet. We're still at the beginning stages.
It's got to be the word of the year already. Jennifer Lee, thank you. BMO Capital Markets senior economist. Lisa Wright to ask the question. We've got a ton of demand. Can labour supply meet it? And arguably, Lisa, more recently, the entitlement spending, the fiscal effort of the last couple of quarters has arguably held back labour supply just as demand has really started to pick up. Now, you're going to have to pay up for that labour supply now, and the trend is just starting.
Well, this is a key question, and there have been a number of studies looking at whether some of the benefits have kept people out of the workforce for longer, or if it's people not going back to school, children and mothers staying at home, or things of that nature. That said, there clearly are these frictions, and a lot of people are looking to an immigration policy from Joe Biden. Why has he not loosened it up more, particularly for qualified immigrants, in order to meet the demand? Because right now it seems like there are longer lasting legs to some of these supply demand constraints.
Thank you, Lisa, for fighting my cause, getting me back into the country. It means a lot. Tom, on a serious note, margins.
Anytime.
You forget I'm the foreigner too. Tom, let's talk about margins this year. Demand's going to be great. We know that. We know that story. And I think this is what Morgan Stanley's trying to get to. This is the execution risk. It's around the margin story. It's around the cost pressures. It's your ability to meet that demand. That's a really difficult equation right now.
It's sector to sector. It's
agreed,
that simple.
Agreed.
I mean,
and within sectors too, Tom.
Yeah, yes, well said, within sectors as well. And what's so important here is the new tone of active management is not what you do, but avoiding the minefields really seems to me to be the theme here. I don't think the minefields are Microsoft or Google or Apple or Amazon. Somehow they're going to have margins that are pretty good.
Coming up, I think we all took note in the last couple of days when Chris Ferrone of Strategas got a little bit more cautious.
Yeah.
We're going to follow up on that with him in the next hour. Looking forward to that. Equity futures up 2 on the S&P, basically unchanged, and the bond market up a basis point to 158. From New York City this morning, good morning. Tom Keene, Lisa Abramowicz, Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden is expected to sign an executive order today that would raise the minimum wage for federal contractors to $15 an hour. It's currently $10.95. The new $15 wage would start next January. The latest U.S. Census figures are good news for Republicans. Texas will gain 2 seats in the House of Representatives under the new population numbers. Meanwhile, states in the Northeast and Midwest will lose 7 seats in a shift of political clout to Republican strongholds. And California will lose a seat for the first time ever. Americans who have been vaccinated may soon get clearance to take off their masks outdoors, according to CNN. President Biden is expected to announce as early as today that the CDC will issue new guidance on wearing facial coverings outside. Some public health experts are calling for less strict guidelines as warmer weather arrives. And more troubles for British Prime Minister Boris Johnson. Allegations of sleaze and incompetence in his government have picked up. Johnson denied a claim that he had said he would rather see bodies pile up than order a third pandemic shutdown, despite multiple reports. Meanwhile, ITV reports that the Conservative Party had loaned Johnson the money to refurbish his government residence. That's a highly unusual arrangement. And investors don't appear to be impressed with Tesla's big quarter. The electric car maker earned record profit in the first 3 months of the year, sidestepped an industry chip shortage, and even made money off Bitcoin. Still shares are lower in pre-market trading. Tesla has to deal with these lofty expectations after its stock rose some 8-fold last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Making this sort of change for that top 0.3% of taxpayers, equalizing ordinary income and capital gains would restore fairness and do so in a way that wouldn't significantly affect investment and that would allow us to make really high return investments for which there's been broad bipartisan support.
That was Brian Deese, the National Economic Council Director from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Tuesday morning, here's the price action. Your two-day Fed meeting commences down in Washington. Equity futures basically unchanged, up 3 points on the S&P 500 to 41.82, positive, not even 1/10%. Our production team pointing out $18 trillion worth of the S&P 500 reporting earnings this week. Yes, really.
Very nice.
18 trillion. What a lineup for you. Wow. A little bit later, Microsoft. In the bond market, yields higher by a single basis point to 158 on a 10-year, Tom, and just short of 121 on euro dollar. Slightly negative, Tom, 120.70.
Oh, yeah, Fed meeting tomorrow as well. Maybe that'll move us off stasis in the bond market. It's certainly there. There are some trends upward, and we'll watch Microsoft carefully this afternoon. Romaine Bostick will have all that on the close. Right now, we go where we fear to go with 74,454 employees, and that would be the infernal revenue system. Martin Schenker joins us, our editor-at-large, managing editor for taxes here at Bloomberg. Once again, the IRS tax season extended because of the pandemic, and I go back to a heated meeting I had with handsome Mark Everson, who was IRS commissioner during the younger Bush administration, and he promised and promised and promised and promised. Nothing happened. They were going to raise the budget, raise the money. They were going to bring in more revenue. It didn't happen. Let's start with what? Let's start with the why. Why doesn't it happen?
Because, when you get down to it, lawmakers are little concerned about the issues of a very strict IRS enforcement on the population and their constituents. They hear from them when the IRS comes knocking on their door.
You and I have visible income and all that, and, I'm honored to say I'm in a tax bracket that's, forces one. It's a transitory tax bracket. There
you want
we
to go there, Tom, right now? Tell us more, please.
Transitory.
He's regretting it, which is why he's
have that
this
conversation.
is about small business. This is about hiding millions and billions. Larry Summers says $1 trillion.
Yeah, and, this isn't the first time an administration has said, look, let's spend the money to do enforcement, and we're going to get multiplier effects of returns. 80 billion will get you 800 billion is what the New York Times is reporting the Biden administration thinks. But getting it through Congress is another matter.
John, this is all about small business, entrepreneurial business, going to their politicians and saying, maybe not.
Well, Tom, I think it's something else, too. Restoring fairness costs money. But also, if you can restore fairness, and even if it costs money, if you can make more money, Marty, isn't that the key here?
Yeah, I mean, that's their argument, that if you, for every dollar you spend on IRS enforcement, you get $10 back. That's been basically the argument over the last 3 or 4 decades. Way back in Wilbur Mills's days, they've talked about increased IRS enforcement, but it just never happens.
Can you make the same argument with capital gains north of 30%? Can you say it restores fairness, but also leads to higher revenue for taxes as well? Well,
I mean, fairness is in the eye of the beholder, right?
Yep,
I mean, if you look at it, only affects 0.3% of the taxpayers. You wonder about this whole question of fairness when it's such a narrow amount of people that it affects.
There's a question, Marty, about whether the tax hikes are in order to pay for some of the plans that Biden has, or whether the tax hikes in and of themselves are trying to impose a fairness. Basically, Senator Warren holding that fairness in the tax code hearing in Washington, D.C., starting at 2:30 p.m. Eastern. Do you have a sense of that? In other words, are tax hikes sort of on the table regardless of whether the $2.3 trillion plan get passed, as well as the $1.3 trillion follow-on about American families?
My impression is yes. That no matter what happens to the second stimulus effort, that they are determined to make wealthy individuals pay more, and that this is a philosophical argument as much as a fiscal one, and that the Biden administration, which can impose these tax increases with only 50 votes in the Senate, is determined to do it. no matter what.
How much Democratic support is there for this philosophical argument, given the fact that a number of them come from higher tax states with actually possibly even a majority of people fitting into that tax bracket counting themselves as Democrats?
Yeah, well, they are really holding fire until they see how this plays out. But as we all know, the SALT issue, the state and local tax deduction, is a very emotional one for many of the representatives and senators from California, New York, and high tax states. And they're not going there unless that gets addressed. And that makes it very complicated.
Marty, the census, we got the first look yesterday. I thought it was really interesting. We get more later. The big city analysis comes later. Really interesting.
Yeah, and what the fascinating thing for me, it was like 800 people was the difference between New York keeping its representation and not. You know, I think we may overinterpret this. If Texas gains a seat, does that mean that that representative is going to be a Republican? When, in fact, Texas is becoming a more purple state and has been for the last decade. So you just don't know how it cuts.
Marty, great to catch up, as always. Marty Schenker there, Bloomberg editor-at-large. And I think in many ways Marty nailed it then, Tom. Is it about a philosophical issue or purely a fiscal concern? And I think many people would conclude...
Oh, you mean taxes?
Yeah, and they'd lean towards the former.
John, I've been
Allow me to finish,
This
Tom.
is nothing...
Just allow me to finish. I'll get there. I promise you I'll get there. I'll wrap things up. I promise you. I'll get there. I'll get there. My question would be whether they have the mandate to actually have this huge philosophical change in the approach.
This is nothing more than a Schedule C debate, John. This is not about the 1040. It's not about visible income. It's about a huge body of America who's entrepreneurial. They make a lot of money, and they take a lot of deductions, and that's what they're going after. It's all there is to it.
Did you ever play that game at school when you passed something round, Tom, and everybody had their time? And they just got to talk and they weren't interrupted.
John, I mean, on taxes, I think the coverage has been baloney. We're funneling in all the rich people into one group. That's baloney.
Tom, I agree with you.
This is about deductions. Mark Everson failed at this 4 administrations ago.
I think you're revealing your bracket a little bit, Lisa, don't you?
Look, I think that there are many different debates here, right? Because what you're talking about is the IRS and the crackdown, the $80 billion investment that Marty was talking about. The idea of capital gains taxes, though, isn't about closing loopholes. That's about raising taxes wholesale. And some people might say that actually will open up more loopholes so that people can get around this or try to get ahead of this. The key issue, though, John, to your point about the philosophical argument is how much does that have clout? Does that hold sway over a party that actually is pretty wealthy, right? I mean, if you look at this is a populist message that speaks as much to the Trump voters as it does to many of Biden's voters. So how much cohesion is there among the Democratic Party to get this through, John?
Fired up this morning. Lisa Abramowicz, Tom Keene, Jonathan Ferro. I'm pretty chilled, to be honest with you. Coming up, Jack Ablin, Crescent Capital Chief Investment Officer and Founding Partner. Looking forward to that. Equity futures shaping up as follows on the S&P 500, up 3. We're positive 1/10% from New York City this morning. Good morning. Your yield is up a basis point on a 10-year to 157.92. Euro dollar 120.70, coming down about 1/10% there. And crude positive 0.8%, $62 and about 40 cents. It's going to be okay, Tom. It's going to be okay. A beautiful New York City. This is Bloomberg. From New York City, this is Bloomberg Surveillance alongside a fired-up Tom Keene, excited, I think, about the two-day meeting at the Fed beginning, alongside Lisa Abramowicz as well. I'm Jonathan Ferro. Equity futures on the S&P, positive about 2 points to 41.81. On the NASDAQ 100, we're positive almost 0.1%. No big moves here. $18 trillion worth of earnings on the S&P 500 this week alone. What a massive number. Talking of big numbers, switch up the board and let's get to this. Let's talk about banks. Not any particular bank, just banks. It's interesting that you would have a bank that would talk about clients needing to disclose more when the bank themselves hadn't disclosed that they took a hit from a certain client of close to $800 million. Not talking about anyone specifically, but here's UBS, down by 3% in Swiss trading this morning. What is material? if it's not close to $800 million. Is it in the context of what happened with broader earnings? Maybe. That was certainly the message that we got from Morgan Stanley as well. So there's your Swiss mover. Let's finish on this one, Tom. I'll finish in the bond market for you. 2s, 10s and 30s. Yields higher by about a basis point to 158 on a 30-year to 226, up about a basis point. Lisa went through some of the supply issues through the week so far. 2-year a little bit soft yesterday. No big deal, though. We'll march through the week with more supply into that Fed decision, Tom, tomorrow.
The earnings out, and it is a blur. We're not going to go through the granularity of, say, General Electric or Eli Lilly earnings, but we are going to find the touch points that describe the larger picture. GE out with a organic revenue growth that is single digit, and Eli Lilly down, I believe it's 3% roughly, on the challenges of margin and the mix of business. Jack Ablin joins us now with Crescent Capital, their chief investment officer. It seems within a boom economy, Jack, that away from big technology, away from some of the winners, there's a real industrial struggle out there for growthiness. Why are the corporations going to struggle here given a boom GDP economy?
Yeah, I think we still are trying to, rebuild the supply chain and get a product to where it needs to be. I think some of the issue that we're seeing from the industrial companies is just rebuilding. So, some of it is translating through at least to some higher prices. I'm seeing now NFIB, the National Federation of Independent Businesses, something like 60% of their constituents saying they're planning to raise prices. Many already have.
Is there a public out there to accept those higher prices?
For right now, there is. Some of it, perhaps fueled by, $1,600 checks. But overall, I think we do have a consumer public that has the wherewithal to sustain these higher prices, and they already have. I mean, the most striking inflation number in March, I think, was pretty strong.
Where is that consumer price tolerance specifically? You find it pretty broad-based? Do you find it within sectors, certain sectors specifically? Jack, where do you find it?
Sure. I think mostly clearly on the investment side. We're seeing it in housing, of course. And anything related to that, we're seeing it a lot of in construction and so forth. Food, energy, it looks like it's pretty much all over the place. I think that where perhaps consumers are turning away some are remarkably on staples.
Do you think this gives birth to some kind of virtuous cycle of higher prices, Jack?
I worry that it will. I think the good news is long-term, big picture, the Fed has a long track record of controlling inflation, but it could come at a cost. I think that's part of the Fed's mantra right now is we're not worried about inflation because we can always tamp it down later. My sense is that interest rates right now are over 100 basis points too low in the 10-year. Just based on a simple model we use between copper and gold. And the Fed is telegraphed a do-nothing policy for the time being.
Jack, even though you do expect bonds to lose value, yields to rise, your recent note said that you're slightly underweight equities and are funneling cash into gold instead. Can you explain why?
Sure. It's really more of a hedge than anything else. I think what we're arguing is, look, financial assets are generally there to preserve purchasing power. And if real rates are negative, financial assets don't serve that purpose. So what would serve that purpose? Gold, which has had a history back to Agamemnon of preserving purchasing power. Yes, it does it at an interest rate of 0, but guess what? So do financial assets right now. So the incremental disadvantage of gold is nil, and we can preserve purchasing power in the meantime. As a hedge, it's also a hedge against the Fed sitting their hands too long. It'll be great for stocks, and we would be underweight, but it'll also be good for gold.
We all appreciate a Tuesday morning Agamemnon reference, Jack. There is a question, though, about equities being also an inflation hedge and certain equities being more that way than others. Do you find that there are some that you can go into?
Different, yeah. I mean, I think cyclical certainly are a good way. We also have developed a strategy for our clients that's what we call quality dividend. These are companies with not only strong balance sheets and the ability to maintain and raise revenues, raise dividends, but they also have pretty strong pricing power. So that's been an area we've shifted away from quote pure balance sheet quality into quality dividend as we're kind of navigating this next wave.
Jack, the next wave as well. The boom economy is going to end at some point. How do you hedge the tail to the boom economy?
Yeah, I think that's a huge issue. I think part of it is we're going to see some valuation contraction. One of the things we note is over the last decade, between 2010 and 2020, that roughly 180 percentage points of the S&P's 280% move was simply valuation expansion. And when interest rates got to 10-year rates got to 0.5, I think we recognized that valuation expansion isn't going to be part of the cards for a while. And so we have to turn our attention to just pure organic earnings growth and dividend yields. And when we look at the market from that perspective, cyclicals are better positioned than growth, just simply because the PE ratio, the reciprocal of the earnings yield is lower. And so historically, if you strip away valuation expansion over the last 10 years, value stocks have outperformed growth, or cyclicals have outperformed growth by about 1 percentage point a year.
Since Lisa's going lyrical here, I'm going to go all Def Leppard and Armageddon it. I mean, forget about Agamemnon. We're going to go Armageddon it. Yeah, get it all. That's the way we feel right now, Jack. We feel like, this is it. Everything's fine. What do I not want to own for when Armageddon comes?
Well, I think with the slowing, there are a lot of pretty stretched valuations right now. Low quality companies, these what we'll call zombie-oriented companies that are running like crazy. Call it whether it's I'm not going to single out GameStop, but certainly that ilk. A lot of speculation in the market. I think that while it's hard for me to get my arms around Bitcoin, it's certainly not a currency. If it were a currency, it would have a volatility that was probably 7 or 8 times lower than it is right now. So part of the reason we chose gold over Bitcoin was because of that consistency. So yeah, I think what you want to be out of just a lot of the companies that are trading a PE and a hope right now, and I think that's going to be that's going to be difficult. Keep in mind, though, Q2 and Q3, we're going to see nominal GDP rates near 10%.
Massive numbers.
So I think we're going to bask in the glory of very, very strong growth. And I've been wrong a lot before, but I defy the 10-year to stay at 1.6 when we've got nominal GDP at 10.
We'll see. Jack is going to catch up. Jack Aplin there, Crescent Capital Chief Investment Officer and founding partner. Let's talk about those zombie companies. What is a zombie company, Tom? Is it a company dependent on low cost of capital, or is it a company dependent on the low labor costs that have dominated the previous cycle? My colleague, good friend Lorcan Roach-Kelly here at Bloomberg, bringing up that point in the last couple of weeks. And I think it's a really important one. We're about to find out who are the zombie companies who have been dependent on very low labor costs. Let's see what that looks like in the next couple of quarters.
Okay, I'll go there, but I really want to go to the cost of capital, and to me, the idea of the persistently free lunch. And John, this goes to the real yield. Folks, look for the real yield on Friday afternoon to drive forward the yield less the inflation cost. And John, the artificiality of where the real yield is just flat out the reason zombies exist.
Whenever you're naughty, you always promo that show. Always. That's just the Tom Keene thing. Does something wrong, comes back and promos the show this coming Friday. Lisa, you've written about this recently, zombie companies in America and worldwide.
The issue here is there are a lot of companies that perhaps would have gone out of business if it hadn't been for the largesse of the Federal Reserve. What happens to them? What do they do to the economy given the fact that they continue? And will the Fed ever let them fail? I can't imagine we're going to see mass defaults in the near term.
But this is the counterpoint to this. Was it the Fed that kept it too loose? or not loose enough for long enough to allow the labour market to tighten and for wage costs to come up? Who are the real zombie companies? And I've heard several people talk about this, not just Lorcan, but also Joe Weisenthal too. And I think it's a really important conversation. If you'd allowed the labour market to get tighter, to actually see real wage growth, would the Ubers of this world survive? Higher wages, would they survive?
I would suggest, and this is with 3M just coming out, Minnesota Mining out with, you know, another Minnesota Mining report. Lisa, is 3M a zombie company because they can't keep up with big technology?
All I know is that my kids buy plenty of Scotch tape, so we're trying to keep 3M alive single-handedly. Okay. There is a real question here about wage hikes and also just sort of how nimble this economy is, John, to change to a very changing dynamic both in labor markets and potentially in debt markets if we do get inflation.
Nice write-up on a Bloomberg today on this inflationary story. The latest ISM report, which I'm sure many of you saw, showed the share of manufacturers saying their cost of inputs rose last month close to a post-2008 high. This is a thing for us this morning. We'll stay on top of it for you. Tom Keene's got more to say.
I go Sheffield with Def Leppard and I get nothing from you.
Tom Keene.
I give you a Def Leppard lyric.
Jonathan Ferro, I missed it.
I got nothing.
I'm not sharp this morning. I missed it. I'm sorry. Coming up, Dr. Ramesh Adalja, Johns Hopkins Center for House Security Senior Scholar from New York City.
Def Leppard, John, they're banned from a few years ago.
Equities, 41.82 of a different time, as you might say. In the bond market, yields are higher by a basis point, 158.
Toto.
This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden is stepping up pandemic assistance to the rest of the world. The U.S. will share its entire supply of AstraZeneca's coronavirus vaccine with other countries. Plus, it's putting together an aid package for India. All this represents a shift for President Biden. He's been focusing on making sure Americans are vaccinated first. Vice President Kamala Harris has pledged an extra $310 million in humanitarian aid to stem a wave of migration from Central America. The money will go to Guatemala, Honduras, and El Salvador. Harris discussed a need for long-term economic growth in a virtual meeting with Guatemala's president. Qatar is ramping up its lobbying efforts in the U.S. It's trying to cultivate a closer relationship with the Biden administration and Congress after being caught off guard in 2017. That's when it faced a Saudi-led boycott in the Persian Gulf. Since January, Qatar has hired 7 prominent firms to do consulting and lobbying work in Washington. And shares of UPS are rising. The package shipper posted first quarter earnings that beat estimates. UPS also reported a 10% increase in revenue per package in the U.S. That's a sign the company is figuring out how to make domestic deliveries more profitable. And shipping containers are falling overboard at the highest level in 7 years. That's sending millions of dollars of cargo sinking to the bottom of the ocean. The accidents are disrupting supply chains for hundreds of retailers and manufacturers, such as Amazon and Tesla. Experts say the pressure to speed up deliveries is raising the chance of making mistakes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is humanity against the virus, and if the virus, finds a way in India or another country to infect people or to evade the vaccine, then everybody on the planet is at risk from that. So, we really do have many good reasons to fight coronavirus around the world.
A tragedy in India. That was Joshua Sharfstein there, Johns Hopkins Bloomberg School of Public Health Vice Dean. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Tuesday morning price action looks like this on the S&P, up almost 3 points. We advance almost 0.1% on the S&P 500. Lisa went through the earnings a little bit earlier this morning, just a ton of them through the week. About a third of the S&P. In market cap, in total, it's about $18 trillion worth. Unbelievable. A third of the companies in the S&P reporting, amounting to about 18 trillion in market cap. Elsewhere in the bond market, yields are higher by a basis point, so 158.09. Euro dollar 127.5. We come in about 0.1%. Crude 62.33. That is the price action cross asset worldwide. Tom, today here in America, we'll be talking about CDC guidance around wearing masks outdoors for vaccinated individuals. Looking for a little bit of an update and clarification today.
Well said. An update and clarification is needed, not only here, but within the crisis in India, in Brazil, in other places as well, including Tokyo having a real challenge of it. We've had wonderful perspective from Amesh Adalja. He joins us now with Johns Hopkins Center for Health Security. Dr. Adalja, good morning, and thank you again for the repeated briefs. We all are benumbed by whichever one of the cases and death statistic ratios we look at. How do you interpret a still elevated cases with the ever lower deaths we see in America? How do you interpret just that simple ratio?
The way I interpret it is that's exactly how the vaccine was supposed to work, because we gave the vaccine initially to high-risk individuals, nursing home residents, and people with comorbid conditions that were in the community. And what we were trying to do was separate cases from their ability to cause serious disease, hospitalization, and death. That's the whole reason we kind of embarked on this whole process, was to try and tame COVID-19. So we're continuing to see that decoupling as more and more of high-risk individuals get vaccinated. So when you go through a hospital, and I worked in a hospital yesterday, it's not the older people that are getting COVID-19. It is younger people who are not yet vaccinated that are where we're seeing cases occur. And those tend to be people who don't require hospitalization, who don't die. Some of them do. Some of them do have severe illness. But that's what we're trying to do, is just remove the ability of the virus to cause the public health emergency in our hospitals that it did. And it's successful so far in the United States, and will continue to be successful as we get more vaccine into people's arms.
Dr. Adalja, what do you make of the fact that, as you say, the people who are hospitalized now are younger, and some people would say even sicker? Is it because of the variants, or is it because just the bulk of people who have not yet been vaccinated are younger, and potentially the people who end up in the hospital have pre-existing conditions?
It's exactly that. It's people who didn't have access to the vaccine but still had some high-risk condition. So yesterday, my last patient was a 47-year-old woman who had morbid obesity, who came in fairly sick from COVID-19, actually gravely sick with COVID-19. And somebody who didn't have access early on, because in Pennsylvania, where I work, first of all, we gave vaccine to nursing home residents, and then high-risk individuals, but in certain age tier groups. So some of those people just didn't get vaccinated. Some of them might be vaccine hesitant, and they still have high risk factors for severe disease. The same thing is likely what's at play at Michigan. So we have to get vaccine into high-risk individuals who happen to be younger, and that's a group who might think that they aren't going to get severe disease because they're younger, and not realize that their high-risk condition is still something that is going to outweigh their age. And that's likely what's happening. There's equivocal evidence whether the variants are more severe. There's some evidence that says yes, some evidence that says no. It's not something that we can say definitively. We know for sure that these variants are more contagious, and we know younger people are more likely to be risk tolerant and not vaccinated. So that variant is finding young people to infect, and it's infecting faster. But again, it's very different walking through a hospital now in most parts of the country than it was just a few months ago, and that's because of the vaccine.
Dr. Adalja, you talk about vaccine hesitancy, and we're expecting to hear from Joe Biden later today, talking about possibly updating the CDC guidelines as to what vaccinated individuals can do. One reason why you're so valuable is because you can dovetail the science with patient psychology. Will this be enough to bring people into the vaccination schedule who might otherwise have been hesitant?
There is a group of the population who is really not going to budge. I've dealt with them all the time. Some of them are colleagues that I work with at the hospital that are healthcare workers, that they just are not going to have it under any circumstances. But there is a group of maybe 20% or 30% of the population that is still deciding, that is on the fence. And one of the things that we need to do is show them how these vaccines, which are safe and effective, are going to change their lives for the better, that things are going to be different once you're vaccinated, that this vaccine is a value to their personal individual lives. And for too long, I think during this vaccine rollout, that wasn't emphasized. So I do think guidance about what vaccinated people can do safely is going to be something that could nudge them in the right direction.
How do we nudge them in the right direction if they don't know the levels of sick and not death that they confront? I see a woeful ignorance about the shades of sickness, knowing that they're not going to die, but they're sick. Have we educated the public on that reality?
We have, but sometimes it goes too far, I think, and then you lose the trust of people, because it is true that the younger you are, the less underlying conditions you have, the less likely you are to need hospitalization, and the less likely you are to die. All of that needs to be part of it, but you have to tell them that Well, you do have certain risk factors. Certain individuals do have certain risk factors for severe disease. You also could be somebody who's left with some long haul symptoms, and that's something you don't want to have anyway. Even if that's something that happens maybe in 5% or less of people, it's still something you want to avoid. So you've got to show people that there are some consequences, disruption that occurs if you get infected with COVID-19, and the best way to prevent that is to become fully vaccinated.
Doctor, great to get your thoughts, your perspective as always. Dr. Amish Adalja there, Johns Hopkins Center for Health Security Senior Scholar. I think Dr. Amish Adalja there just touching on an important point, Tom. Sometimes it can go too far, and what you end up is an irrational fear of this disease as well, and there's been issues with that too.
Yeah, there has been. I mean, I just think that we're almost, John, at a clumsy stage right now where we're seeing these phenomenal decreases in deaths, but the pros have a huge level of angst out there about the people that are sick, and I'm not sure I sense that in the public.
Well, Tom, I want to understand also what the follow-on is as well. Once we start to move further away from this pandemic in this country, and I hope that's soon, and many people, of course, share that hope, do we start to tackle things again like obesity in a bigger way? Or do we treat them as taboo issues that you can't talk about them because somehow you're fat-shaming people? Are we actually going to have that conversation again in this country
America,
in a much bigger way?
In America, no. Plain and simple.
But hasn't that been a big problem in this country through this pandemic?
Huge problem.
So why aren't we having a serious conversation about it?
Because it's America.
So we're more comfortable having people fearful on the streets in the open air wearing masks than we are about having that conversation?
Yep.
I think, John...
I just don't know what else to say, but there's a huge differential here on, mostly I'd say, John, it's into food consumption, size of meals. Like me and Lisa Celeste.
Anytime.
Anytime.
Lisa Abramowicz, Tom Keene, Jonathan Ferro. Coming up, Chris Verone, a strategist from New York City this morning.
Lisa wants to weigh in on this.
I know she does. She had about 20 seconds she could have done.
Well,
clock's ticking.
We'll
You can
circle
go.
back.
I think that this will be the issue that we have to deal with next, especially pandemic weight gain, and we have to talk about that.
Agreed. Equity futures up 3 on the S&P.
Such a good band.
From New York. This is Bloomberg.
Pandemic weight gain.
We just can't catch up after going through a depressionary bust with this health crisis to suddenly having a runaway bull market.
We know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change? We're all becoming behavioral scientists.
The real question is, beyond the summer, after we get this reopening-driven boost, how long is this going to sustain itself?
All eyes really are on what constitutes substantial progress right now.
What's this economy look like 6 months, a year down the road? And that's where I think you're going to see this real inflation, and it's going to be more persistent than people are currently pricing in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Earnings season revving up from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures positive, a little more than 0.1%. Better revenue growth through the year ahead, year on year. Of course, that is the obvious story, Tom. It meets higher costs.
A wall out there. I wish everyone could see this. So the famed Bloomberg headline service is just a wall of earnings coming out at 7:00 at Wall Street time. Just, hundreds and hundreds of headlines, John. And to me, the story is they're managing it. The margins are there. Earnings are there. Maybe there's some forecasts. But it is a real story, corporation to sector, on revenue growth. What is it now and what will it be?
And what will the higher costs do to the margins on some of these companies' balance sheets, Tom? This is the story from Bank of America. I mentioned it in the previous hour. I'll do it again for our radio audience too. The number of mentions of inflation during earnings calls have risen sharply, more than tripling year on year per company so far. The biggest jump in our history since 2004. That's the theme so far of Q1.
Just one of 200 headlines. Archer Daniels Midland, they expect significant EPS growth, another record year in 2021. But then you look at the revenue mix forward, and John, with Verone coming up, this huge mystery of Q3 and Q4.
Q3, Q4, the year ahead and into 22, Lisa. The mystery of that deceleration. That's what we need to start getting our hands around too.
Yeah, and the mystery of just how much some of these consumer staples can pass along these higher costs, these higher input costs. You're talking about the inflation mentions. And it's interesting that Coca-Cola, Chipotle, P&G, Kimberly-Clark, they're all saying they can pass along a lot of these costs. The question is, does that mean that individuals who possibly aren't earning as much in terms of higher wages, whether they stop buying as much? And that speaks to the deceleration that you're talking about.
Going to run through the earnings through the morning. Good morning to you all. Your equity price action this Tuesday looks like this on the S&P 500. Equities up about 5 points, a little more than 0.1% to 41.85 on the S&P 500. In the bond market, yields up a single basis point. Let's call it 158 going into the Fed meeting and decision tomorrow. In the FX market, euro dollar 120.80. We're in about 0.1%, Lisa. No drama, muted price action this Tuesday.
No drama, but definitely to your point, there seems to be a growing consensus about how possibly the more surprises could come out, positive surprises of Europe than the U.S. I'm watching Washington, D.C. Project Get Vaccinated. President Biden will be giving updated guidance potentially from the CDC on what you can do if you've been vaccinated. Maybe you can take off a mask in public. Will there be something more to entice some of the hesitant to get jabbed? Meanwhile, 2:30 p.m., there's going to be a Senate Finance Subcommittee talking about taxes. I'm interested to know about this philosophical debate, this idea that among the Democratic Party, there are some that just believe that taxes should be higher for wealthier individuals, less necessarily to pay for specific plans, versus the Democrats from particularly high-tax states, and I'm thinking in particular Chuck Schumer, pushing back on that and saying, that's not really good enough for us. And also today, after the bell, Microsoft and Alphabet both reporting earnings. One thing, and John, you were talking about how there have been incredible beats, and I've been interested. There was a UBS report showing that that companies have beat earnings by about 25% versus the average of 11%. Just the idea here that the beats have been tremendous. We have not seen the follow through with price action, which makes me question, what are markets following? If it's not faith, if it's not the actual reality, what's driving the price action?
Listen to what the markets are telling you. Tom, that's what we're always told. Let's get to JetBlue just quickly. JetBlue, Tom, expected to reach break even in the third quarter. That's the look ahead from JetBlue, an airline here in America.
The struggle here, I mean, it's very granular, but, they're countable. I mean, they're counting bodies and they're counting the revenue and the margins coming in. And, they're giving a third quarter vision. You wonder, do you get a third quarter vision from Microsoft?
Joining the transatlantic corridor soon as well, Tom. JetBlue, get into the mix.
Yeah,
New York,
I don't know much about
London,
that. I mean,
Boston, London as well, I think.
There's the Mint thing. They do Mint like business class.
Have you tried that? It's actually pretty good, Tom.
Yeah.
It's good.
I mean, I sort of like their planes, like I actually fit in them.
You fit in the plane?
A lot of, you'd be stunned at some of them that, I don't really...
Value add.
Real talk. It's the real talk. I will say the Mint offering, the business class offering at JetBlue is pretty decent. I'll vouch for that.
Very good.
Thank you. Chris Verrone, Strategic Head of Technical Strategy and Macro Research, joins us now. Chris, good to catch up, sir. Listen to the market. You've become a little bit more cautious in the last couple of weeks, Chris. I think we all took note of that. Why?
I just want to be aware of where we are in the cycle. I feel like we're at that point where this collision between expectation and reality is playing out in real time. And just think about how a market cycle matures. The first 6, 8, 10, 12 months off of a low, it is remarkably easy to beat very low expectations. As that cycle matures, I think the bar gets higher. I think we see that with some of the sentiment data. I think, as Lisa points out, some of the responses to earnings might not have been as robust as one would expect, given the strength. And I think ultimately what we have to figure out here is, are we heading into a period of peak data? And peak data historically has been met with corrections. I'm thinking about 1984, you were 13, 14 months off the low. You got some of the best data of the cycle, and you went nowhere for 10 months. I'm thinking about 2004. You get PMIs in the 60s, and you had a good correction the first 6 months of 04. Think about 2010. You were 13, 14 months off the 2009 low, and the market stalled with the best data of that cycle. So I just want to be a little bit respectful of where we are. There's really not much in the charts yet to support this view. What we're doing here is building off history and saying, okay, what do we need to be mindful of over the next couple weeks and months?
Chris, that's right where I wanted to go, which is what is in the charts. When you look at individual charts, when you look at sectors, when you look away from equities, what do your charts guesstimate about the inflation fear that's trenchant right now? It's just knee deep.
Tom, I think the sector right now that is telling the most interesting story is consumer staples. I think staples are help answering 3 questions. So yesterday, Staples made fresh relative lows versus the S&P. So Staples are at their lowest relative point versus the S&P we've seen at any point over the last several years. To us, that answers three questions. Number one, it says we're probably not late cycle. Staples tend to outperform late cycle. They're not doing that here. Secondly, I think they argue that some of the price and inflation pressures are stickier than the Fed tells us that they are, right? Staples are very sensitive to food input costs. We've seen what a lot of the food stocks have done over the last several weeks here. They rolled right back over. And then third, if bond yields were going lower, wouldn't Staples be stronger? So I think the weakness, the relative weakness in Staples, the relative weakness in utilities suggests that bond yields probably don't go a ton lower from here. So the Staples for us are telling a lot of very different, interesting stories.
Chris, the idea that bond yields might not go much lower from here, does that mean that bond yields will go much higher from here because of those inflationary pressures that perhaps, as you say, might be trending in a stickier and more significant way than the Fed is considering?
You know, I think we're pausing yields basically on sentiment and flows. If you look at some of the sentiment work in the bond market, you know, 3, 4, 5 weeks ago, you got to a point where just everyone was a bond bear. And I think there needs to be a sentiment response from that. And we've seen that over the last month. But I would turn your attention to some other areas of the world, like German bond yields really have not gone down. I think before you were talking about the areas of the world where there's room for surprise, the fact that German yields have not gone lower, I think tells us the ability to surprise in Europe is probably easier than it is to surprise here.
So add to that, Chris, have you got a conviction long in Europe right now?
Yeah, I think these European autos, which basically spent the last 5 or 6 years in purgatory, have all turned. There are leadership groups within Europe. I think the industrials within Europe. But look at the materials. All these big global material stocks, many of which are found in Europe, are breaking out of these big bases. Isn't that screaming weaker U.S. dollar to us here as well? You had this tepid rally in dollar over the first 3 months of the year. Dollar has rolled back over as these big global bellwether material stocks have broken out. I think this is all telling us the same story.
Chris, always good to see you, mate. Chris Ferro, Strategic Head of Technical Strategy and Macro Research. Autos in Europe up almost 21% year to date so far, Tom. What a run that particular sector has had.
You know, I looked at a lot of log charts today, John, where slope matters, and you're absolutely right. The leg up here, and we're just addicted to it. I mean, you know, there was a real measured view in January. It was wrong. It has been, as you say, what a run. And the answer is, can it go forever? And the answer is, we heard from Mr. Verone, no, pauses are in order and healthy.
You know what I've struggled with? If you look at the economic data, of course, the pickup hasn't been synchronized. Q1 was America's quarter. If you look at the price action, a lot of that has synced up. Europe, US, Lisa. The banks on both sides of the Atlantic have done well. It's not as if we're coming into Q2 with European banks severely underperforming US banks off the back of better growth in America versus worse growth in Europe. I understand the bar for relative surprises here for Europe. I've made that argument. We've been pushing that through the FX channel. On the equity side, I think it's a little bit more complex. It's more nuanced, more difficult.
Yeah, the question is, are people perhaps looking past some of those risks, the differentiation, and look in search for the idea of a discount in a very highly priced world? I do want to say something that was really interesting that I read from Societe Generale's Steve Englander this morning on the Euro call that Chris Verone was just talking about. He said that the U.S. trade deficit may have widened dramatically in March and that this could actually weaken the dollar. The idea here that all of that money that the U.S. government put in the hands of individuals went to buying stuff that helped the rest of the world, that caused the imports to way outweigh the exports from the United States.
That thud you just heard was in Singapore, Lisa. Mr. Englander, who's been at 42 firms in the last 44 years, holds court at Standard Charter. Not SocGen, but that's okay.
It's okay.
We'll let folks, what Lisa just did there.
Transitory employment.
What Lisa just did there. I can't keep track of where anybody is, John.
I agree.
I mean, it's totally.
I know it's tough. Well, it's particularly tough in foreign exchange sometimes too, Tom.
You don't even know, like, Jordan. Where's Jordan Rochester this week?
Nomura.
Okay, thank you.
Still, I believe. Coming up at 8 a.m. I think
some of these
Jordan
people
Rochester's
have been
probably
like
listening to this right now, thinking, I hope so.
3 firms in the last 6 months, and you're like, we're in our ears to Riley. Where are they?
James Bevan is still at CCLA. He's still the Chief Investment Officer, and he'll join us in the next hour. Equities up 4 points on the S&P. We advance a tenth of 1%. Euro dollar 120.81. Your bond market, your yield higher by a basis point to 157.92. From New York City this morning, good morning. Tom is with Bloomberg still. I can confirm. This is also Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden's proposal to boost the capital gains tax would hit individuals earning $1 million and married couples jointly earning the same amount. The president is set to unveil his plan tomorrow. It would almost double the capital gains rate for some taxpayers. Meanwhile, President Biden is expected to sign an executive order today that would raise the minimum wage for federal contractors to $15 an hour. It's currently $10.95. The new $15 wage would start next January. The latest U.S. Census figures are good news for Republicans. Texas will gain 2 seats in the House of Representatives under the new population numbers. Meanwhile, states in the Northeast and Midwest will lose 7 seats in a shift of political clout to Republican strongholds. And California will lose a seat for the first time ever. General Electric burned more cash than expected in the first quarter. That's crimped CEO Larry Culp's turnaround push after signs of improvement. GE's earnings did beat estimates, but still Culp sees a difficult environment for the crown jewel of GE's industrial business, that is GE Aviation. U.S. companies face soaring bills for all kinds of materials that they need to do business, and rising demand is helping them pass on those costs to customers. In earnings calls, executives from businesses ranging from Chipotle to appliance maker Whirlpool have outlined price hikes. Their comments back up the data that show inflationary pressures building in the economy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
We have been reminded that the status quo is not nearly good enough, and that innovation is indeed the path forward. For our part, the United States will work to end the pandemic with our partners and allies. We will invest in our health security at home and globally.
That was Vice President Kamala Harris addressing members of the UN from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Tuesday morning shaping up as follows in the equity market on the S&P 500. Equity futures up a little more than 0.1%, positive 5 points on the S&P. We have $18 trillion worth of earnings this week on the S&P 500, an unreal amount. Apple coming up tomorrow, Amazon on Thursday. Into the bond market, where yields are higher by a basis point to 157.92. Euro dollar basically unchanged now. The euro against the US dollar 120.81, and crude up 0.6%. WTI $62.30. Racing through the earnings for you. This one just for you, Tom. Crocs full year revenue growth to be between 40 and 50%.
When you and I had lunch the other day in Soho, you had on those classic Neo Puff Crocs.
I love them.
They were great. The yellow ones that you have.
I had no idea that people actually wore these seriously, but apparently they do. Full year revenue growth to be between 40 and 50% year over year.
And I bring this up, John, because it's sort of, to me, anecdotal. I mean, it's like company to company, and we're all focused on Amazon and all that, but each company has a story about how they're doing in this horrific natural disaster.
Well, they're doing pretty well, apparently, Lisa, raising 2021 guidance for the year.
The Crocs story is that everyone's home and they prize comfort over all else, and so Crocs are surging.
And the outlook's better too.
That sounds like a woman speaking with authority
this
there.
Trend continues.
Well, I mean,
this trend continues. People have just given up.
People have given up. That's how you interpret it. Yeah, they've given into a new life.
Jack Fitzpatrick joins us right now. He is certain there isn't a Republican that would be caught dead in Crocs, and he joins us from Washington this morning. Jack, the president will speak, and it will be a most interesting speech to the middle of both parties. How did those middle parties shift with the census announcements yesterday? They wake up with a new America for the next 10 years. What's it mean for moderate Democrats? What's it mean for moderate Republicans?
Well, in a practical sense, in the near future, some members are going to be worried about getting redistricted out of their seats. And it's unclear exactly who, but the ones in the states that are losing seats, Michigan, Illinois, Minnesota, New York, Pennsylvania, California, Alabama, are they're potentially in trouble. That's a political minefield there. More broadly, as we look to 2024, a lot of this is a shrinking Rust Belt. And as you saw, growth in Texas and sort of more the Sun Belt other than California. So it really does throw things out of whack, I think, especially for Democrats who got gains in 2020 in those key states like Pennsylvania and Michigan, which are now losing a seat each.
Then how does President Biden adapt not only in this important speech, but forward to the new reality that he's got to do better in Texas?
Well, one, he is leaning into policies that are popular, that may be tough to get bipartisan support for in Congress, but that plays well in the polls. So I think in this speech on Wednesday, he may actually be playing a little bit more to the left of the party, talking about childcare, free community college, pre-K, social programs that aren't exactly centrist, but that poll very, very well. And then other than that, there is an aspect of racial diversity. The white working class conversations that we had after 2016 apply a little bit less to presidential politics, and the lessons that Democrats learned in Georgia. For example, Georgia isn't gaining a seat, but that's the kind of state that is increasing its clout in the long term.
Jack, how do capital gains taxes appeal to Republican voters, in particular those who voted for President Trump?
The capital gains tax may not appeal to Republican voters, but that is one of these issues, along with the increase in the corporate tax rate that Biden is pushing, where he's very aligned with, say, the Bernie Sanders side of things. And it is a sort of populist approach. It's interesting that he's played it both ways. He's pitched that as a tax policy on its own, but also as a pay for this next round of legislation. So he's tying that rhetorically to free community college, childcare, and that kind of thing.
Jack, can you lift the lid just a little bit for us up here in New York on what is happening down in Washington with the lobbying effort from big tech companies, the people who are affected by this discussion that we're having right now? What does that look like at the moment?
Well, in terms of lobbying, I mean, a lot of this is happening out in the open because there's so much Republican opposition to what Democrats want to do on taxes. So I even, lifting the lid, it's very, very clear Republicans are outright opposed to not only the capital gains issue, but a lot of the corporate tax proposals by Biden that he wanted to do sooner in this next bill, the infrastructure bill. There may be some middle ground, but really clearly it hasn't even taken a lot of lobbying to get very significant opposition to these proposals, and anything that's going to become law at this point, unless they ram it through in a partisan way, is going to have to be very, very watered down.
Jack, good to catch up, as always, down in Washington. Jack Fitzpatrick there, Bloomberg government reporter. I want to turn to some earnings this morning as well. We've got a lot to get through. UPS up by almost 7% in early trading. Tom, it was a big beat, up by 6.93% in pre-market trading right now.
We're making jokes about it, Crocs and all that, but this is really serious. This is a real litmus test, John, for the entire nation. And if I'm at Microsoft, and particularly if I'm at Amazon, the UPS story is great news.
Amazon on Thursday, Apple coming up on Wednesday, Lisa.
Yeah, sales of UPS climbed 27%. Not entirely surprising. I guess the key question with UPS is exactly the labor cost, wage dynamics here, given the fact that they have to hire enough people. I mean, they are dealing with labor shortages along with a lot of other companies, John.
Dreaming of reopening is easier than actually doing it. The words of Mike Wilson over at Morgan Stanley. This is going to affect different companies differently. Tom, just to state the obvious, this is not going to be a broad-based story. I think it's going to be really interesting to see who can meet that bigger demand.
On a unit basis, Lisa just nailed it, John. It is about hiring the marginal unit worker.
Yep.
That's going to be, right now where I sit, that is the theme for the next 200 days. Where do you find the next worker?
And labor costs are going where, Lisa? They're going up.
Yeah, and really, I mean, they're being spurred up also by this $15 minimum wage proposal by President Biden this morning, an executive order for contractors with the federal government. You do wonder how much staying power this has. Does this count as, should I say it, transitory?
Transitory.
Where's Tom? Is he drinking?
You think the news conference is interesting tomorrow?
Yeah,
With
I
Chair
do.
Powell, I do too.
I think it'll be fascinating.
I think it could be interesting. I don't think policy changes in any way, shape or form. I just think the conversation's shifting already, and they've got to respond to that. It's a big chug you're having there, Tom.
Transitory.
Coming up, Vasilios Giannakis, Bank Lombardo DA head of FX strategy.
And I'm trying Cholula.
How's that working out, Tom?
With the Worcestershire sauce, the Worcestershire sauce, it doesn't really work.
Worcester sauce, Tom.
The Leicester sauce.
Worcester.
Value add.
God, how many years have we worked together?
They didn't get relegated.
Can't believe
Watford,
we've
Worcestershire
survived this
should
long.
be a great game.
From New York, this is Bloomberg. Live on TV and radio for our audience worldwide. Here's the price action on the S&P 500, the Nasdaq, the Russell. We advanced by 4 points, up a little more than 0.1% across the board here on the Nasdaq and on the Russell too. We're up just a little bit. Let's flip things forward into the bond market, switch up the board. 2s, 10s and 30s. Yields are higher by a couple of basis points at the long end curve, just a little bit steeper. 226 on 30s, about 158 on 10s. I'll keep moving forward quickly. Let's finish on this. Copper. Lisa brought this up yesterday. Now the highest since March 2011 and pushing towards 10K here.
LME 10,000.
On the London Metal Exchange. Thank you, Tom.
Yes.
We're up by about 1.5% intraday.
For our American audience, bear with us.
We'll get there in a moment. The miners in Europe up more than 20% on the Stock 600. That appetite for copper has come back again after topping out in the middle of February. We take out that high and we push forward to 10K. You want to talk about the LME a little bit, Tom?
Please,
move things forward?
Please, I insist.
The heritage of the London Metal Exchange.
You know, I'm looking at London. Oh, I'm looking at London LME Palladium.
And what do you see?
Moonshot, hyperbolic.
Shiny metal.
Thank you. Copper, 98.92, just unbelievable numbers. We'll touch on that a little bit more a little bit later. The earnings today, tomorrow, Thursday, all piling up. Here's Romain Bostic.
Yeah, a fire hose of earnings this morning. Of course, let's start with travel, housing, and I guess e-commerce here. JetBlue Airways did actually report here. Interesting, demand is picking up, and the company seems pretty bullish about that demand really persisting through the summer. The problem is those costs are rising. Labor costs are rising, as well as those fuel costs, and the company's saying that's actually going to put a crimp, at least in profitability going forward. There's also a little bit of concern here about revenue on a year-over-year basis. The forecast is still for a drop in revenue from the previous year here, though still an improvement here from the pandemic levels here. Pulte Group actually reporting earnings, and they were pretty much knocked it out of the park here. Sales for homes continues to go higher. Pricing power continues to work in their favor, but investors may be a little bit concerned here about the persistence of some of this. Remember, you're talking about 19% revenue growth in the first quarter. That was about what the street was expecting, but they're still looking for 20+% growth for the next 3 quarters, and I think some investors are now starting to wonder whether that's going to be met. UPS also having a great quarter as well. Interesting number here was what they made on international revenue per piece. This actually rose about 12%, and this is a huge metric because remember, that actually dropped in the previous year-over-year comparison, primarily because of the pandemic. So a little bit of a return to normalcy here. After the bell, another deluge of earnings going to hit as well. Keep an eye on Microsoft. This is going to be a huge story. Gross margin expectations for this company, 68%. That's what the street is looking for on this company. A company that right now that has just shy of a $2 trillion valuation. Alphabet also reporting we've already gotten a peek at some of that digital ad spending. It appears that Google probably is going to continue that streak that we've seen for some time. So expectations higher for both of those companies. Expectations not all that high for Starbucks here. They've been really hurt by coffee prices. Arabica beans right now at a 3-year high.
Romain, did their story shift, their ballet shift this afternoon on the close because of the Apple announcement yesterday? Does Microsoft got to come out and, talk about state funding and job formation and all that?
I mean, well, I don't think investors care as much. The other problem, though, is Microsoft doesn't really need to. I mean, the thing with the difference between Apple and Microsoft is Microsoft, to a large extent, is still a growth company. Apple really can't claim that anymore. It's always been, or at least for the last few years, it's been much more of a value play, and you have to give investors a little bit something more than just that 5 to 6% juice that they're getting every quarter.
Is that it?
I mean, there's tons of other earnings, Crocs earnings, ADM.
Crocs, please, Romaine.
ADM.
Crocs, please.
They're doing well. Justin Bieber's on board, the Bieber bump. I know you've got a few pairs in your closet there, Tom.
I do.
Keep rocking them. Yeah.
Justin Bieber wears Crocs, does he?
He was a big endorser of them.
I did not know
this
that.
has been a huge
There we
strategy
go.
for Crocs in all seriousness.
I can't
they
say
get
I've
the
been
celebrity
following it.
endorsements, John.
I have not
you
been
could be next.
Following it.
He is. No, John's got the yellow Neo Puffs. They look great. Okay, Romaine,
Is this
thank
what
you so
wealthy
much.
people embarrassed of their wealth do? They wear Crocs. Is that what that is?
Yeah, that is. You know, it's like if the Biebs is doing it, John, you got to get on board.
Okay. It's
Right
working
now in
for him.
foreign exchange, Romaine, thank you so much.
you.
Very
Thanks,
importantly, to
Romaine.
close, must watch, must listen this evening. They do the 5 anchor thing. They're right at the close, very informative with the earnings coming out. Right now, Vasilio Giannakis with us, Bank Lombard ODA, as we look at the foreign exchange. Vasilius, I've got to go right to the dollar and the catalyst for the when of dollar weakness. What will drive dollar, say DXY, finally below 90?
Well, I think it's going to be when we get further confirmation that the vaccination rollout in the European Union is gathering pace. I think what we're getting right now is that we are in a really good global scenario where you have a big global growth and trade upswing. You have commodity prices rising because pent-up demand is rising. There are some question marks, one about the pace of potential future yield increases, and secondly about how the vaccination rollout in the EU is going to pan out, which is likely to affect the growth outlook, especially in H2. I think on both fronts, the view is that the pace of yield increases is going to be normalized, so it's going to be consistent with the fact that global growth is picking up, but it's not going to be abrupt as it's been in late February and in March. And recently, over the past 2-3 weeks, we've seen it pick up the first derivative of the vaccination rollout in the EU, picking up some pace, albeit from very low levels. But nonetheless, I think a lot of that has already been in the price. So I think from a fundamental medium-term view, I think the dollar goes lower from here, with the only caveat of the May seasonality. There is a very strong element of May seasonality,
Right.
which is the dollar higher.
Is there going to be a lot of jawboning about stronger euro? Do you anticipate that we will see nations saying enough of this weak dollar strategy, or is that an ancient idea?
Look, it's something that, we've been talking a lot about recently. Everyone is really focused and obsessed about euro-dollar. But let's not forget that what's really relevant for Eurozone inflation is the trade-weighted euro. This is what really matters in terms of the pass-through or not of prices into domestic inflation. And in that respect, Euro-China has the biggest weight. Now, to the extent that you're talking about a broad-based, generalized dollar weakness, euro-dollar upside is not going to translate into euro-China upside, more likely potentially euro-China downside, because the renminbi has plenty of appreciation to go to. So in that respect, I think this will keep the trade-weighted euro in check, and I very much doubt that we're going to get a collective synchronized by all governing council members of the ECB noises about the level of the euro.
Vasilios, just pick up on that. Euro-China down on the year, with you there, but there's a clear slowdown, or at least a maturing of the recovery going on in China. The credit impulse is rolling over in China right now. What's going to drive that additional renminbi strength?
Well, I think there are a lot of factors. First of all, I think it's quite clear that the PBOC is in a very slow tightening mode, and indeed we expect some 30 basis points of tightening towards the end of the year or beginning of the next. Secondly, the other important element is that you keep on seeing portfolio flows going into China. These are flows largely because of the gradual process of capital account liberalization, but also as well of the fact that Chinese bonds are being included into bond indices, and this thing has not been exhausted. And what's interesting is that a lot of the flows that come into China on the corporate and the retail sector have not actually been converting it to renminbi already. As a matter of fact, over the past 8 months, a large chunk of domestic players have actually been hoarding a lot of dollars. They have accumulated about $180 billion, which is quite unusual. And we expect that this thing is going to start unwinding, meaning that domestic players are going to start converting these dollars into the renminbi, pretty much reminiscent of what happened, I think it was about 4 or 5 years ago, back into 2016, and this is going to lead to another leg lower into dollar China and potentially other renminbi crosses.
Vasilios, when does the PBOC, the People's Bank of China, get involved to suppress the renminbi's rise? We saw it peak out at, I believe, 7.2 per the dollar. When does the PBOC get back involved, given the fact that we're all the way back down to 6.479?
Well, I think that the PBOC is one of these central banks where they learn by doing, and they try to avoid mistakes from the past. I refer to what happened back in 2015 of the devaluation and everything. Basically, my main point is that I think right now they have shifted into a regime in which you have a controlled appreciation. And I think they're very happy with it, and I think they're pretty comfortable with the renminbi going higher in a normalized fashion. Now, if you look at the renminbi, the CFTS basket, typically you tend to think of the PBOC having a range between 92 and 98. However, if, that rebounding global growth rate continues, the fact that China has not lost a share in export competitiveness, then I don't think that the PBOC is going to have any problem seeing the trade-weighted renminbi, the version of the CFTS basket, breaking above 98.
Vasilios, we've got to leave it there. It's always good to catch up, buddy. Vasilios Giannakis there, Bank Lombard Odier, head of FX strategy. On the ECB and tolerating a stronger currency, Tom, I wonder, in a different kind of question, whether they will tolerate the high yields that could lead to a stronger currency. Will they see it as consistent with a brighter outlook in the same way the Federal Reserve did more recently? And I think many people have their doubts about that.
The history is they will jawbone. The question is when. John, we heard 6 months, a year ago, it'd be 130, then it was 128, then it's 125. What do you think, John? Up 3 figures here and they start, yapping
Maybe.
Well,
we've seen it before, Tom. I think the thing that's going against the ECB right now is they don't seem to be on the same page on anything at the moment.
Yeah.
The governing council's starting to split in a way that we have done before, at least according to several reports, and that could get dicey in the months to come.
The microcosm of earnings, John, I want to go away from Amazon, Microsoft, Alphabet as well. Hubbell, Shelton, Connecticut. John, they make 130,000 electrical parts. You know what? They got revenue growth, high single digit. They're minting money, and they're raising their dividend. They're up 90% off the bottom.
Raising their full-year earnings forecast too, Tom. The guidance is better as well. That's the story in America right now. A better outlook. That's been the story of the last 6 months. Equities up 4 points on the S&P. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden is stepping up pandemic assistance to the rest of the world. The U.S. will share its entire supply of AstraZeneca's coronavirus vaccine with other countries. Plus, it's putting together an aid package for India. All this represents a shift for President Biden. He's been focusing on making sure Americans are vaccinated first. And President Biden is staking a claim on economic issues ahead of the 2022 midterm elections. According to his advisors, the president's infrastructure and family support plans are an appeal to the discontented white voters who put Donald Trump in office. He's also targeting independent suburban women. Polls show there is some Republican support for the Biden proposals. Qatar is ramping up its lobbying efforts in the U.S. It's trying to cultivate a closer relationship with the Biden administration and Congress after being caught off guard in 2017. That's when it faced a Saudi-led boycott in the Persian Gulf. Since January, Qatar has hired 7 prominent firms to do consulting and lobbying work in Washington. Eli Lilly has cut its forecast for annual earnings per share. That's after the federal government cancelled an order for the company's coronavirus antibody. Instead, the agreement now focuses on Lilly's combination treatment. Earnings and revenue both missed estimates. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Decompose the decline in rates. It's all been led by real rates. So I think the markets finally heard the Fed, that the Fed is going to be extremely patient, that they're going to see actual data, not just forecasted data. And so therefore, with the Fed controlling the front end, not even talking about tapering, I think that limits how much rates can rise.
It's almost tedious, isn't it? Most people just agree with each other on the Federal Reserve going into tomorrow. Priya Misra, TD Securities Global Head of Rate Strategy from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Equity futures up 3 on the S&P 500. We advanced not even 1/10%. Yields are up a couple of basis points on a 10-year to 158.27. Euro dollar totally unchanged. Euro dollar 120.85. That's the story right now cross asset. Let's get straight out to Zurich, Switzerland. UBS taking another hit from Archegos. I say another hit because it's been bank after bank taking hits, Tom. The total hits now more than $10 billion from that one investment firm. Unreal.
It is a whale, but a different whale than what we saw over 10 years ago. Jonathan Tice joins Bloomberg Intelligence, senior analyst for beleaguered European banks. Jonathan, it's 300 yards between UBS's headquarters and Credit Suisse headquarters, up and away from the lake. Great. What's the difference right now between UBS and Credit Suisse?
Well, obviously, UBS has a slightly smaller wound to lick from the Archegos fallout. And with the new CEO at the helm, clearly he has the sort of fresh set of eyes perspective. And I think, for example, prime brokerage, UBS are probably likely to retrench far less than, say, Credit Suisse. But clearly both of them somewhat blindsided by what happened with Archegos.
Well, clearly investors too, Jonathan, because no one was told how big it was. We were just told it wasn't material. Can you help us understand that a little bit more? When a bank says from now on that it's not material, what it actually means?
Well, I mean, bear in mind, I think the sell side was probably looking at low hundreds of millions of dollars. So, yes, it's another 300 or 400 million, but in the grand scheme of things, over a year's earnings, not huge. It is somewhat surprising that they weren't in a position to give a much tighter number, but I guess because all the attention was focused on Credit Suisse at the time, maybe they thought that they wouldn't have to worry and perhaps things could settle at slightly different levels. And it's not like we haven't seen this in the past, and things have been revised upwards, but we've got a very accurate figure for 2Q. So I think the share's down 3%, with some very strong wealth management and private banking, etc. flows. Just reflects a little bit of disappointment, but nothing more, because we should be able to draw a line under this particular incident now.
Are there potential risk management issues, though, that come up, especially due to the fact that they didn't think that it was material to mention this, and the likes of Deutsche Bank, set to report later this week, evidently missed out on this risk?
Well, it looks like, if you look at the news stories, Deutsche did actually manage to exit the positions pretty swiftly and far more efficiently. So I suspect that everybody had a bit of this, and it was a question of who was most aware. So risk management and UBS, as I say, they've got a new guy at the helm. No doubt he will be having a look at this too, thinking, how did this happen? Why wasn't I told immediately? But he was quite clear in the interview earlier that he's not looking to aggressively retrench from prime brokerage.
We're talking about the Archegos hit, and there were some positive wins here, particularly when it came to wealth management. However, still a lot of cost pressures, and I see that HSBC is cutting office space by 20% this year and having business travel. Are European banks only playing a game of cost cutting at this point?
Well, actually, I think European banks are still somewhat behind the curve for cost cutting. I mean, bear in mind that everything was put on hold last year as the pandemic hit. And if you look at a lot of European banks' retail footprints, think Italy, think Spain, think Germany, these are some of the most overbanked countries in the world. So you've still got an enormous retail property footprint. There's a lot more to come. We've seen BBVA and some of the other Spanish announce very large headcount reductions over the past couple of months, and we are going to see more. So, no, I think that there's a lot more to come.
Jonathan Tice, you are expert at the revenue compare and contrast. I'm always shocked at how small the Swiss banks are on a revenue basis relative to the U.S. big banks. What is their transactions and combinations future? What does UBS do? What does Credit Suisse do?
Well, I mean, they've both gone reasonably aggressively down the private banking wealth management route. If you think about UBS and its retrenchment out of fixed income, which is very similar to what we saw with Deutsche and equities, they've become far more selective in the businesses that they're in. So I think when you think from a sort of non-investment banking, and actually even there, equities is reasonably big for, say, UBS, they certainly punch above their weight, and I think they're sort of top 10 globally. You forget, I think, quite how big the US banks continue to become as Europe spent a decade in turmoil.
John, before you run, how's this for a stat? It comes from Shaheen Nesirapur here at Bloomberg News. Coming from the Fed data, Tom, total loans and leases fell to a record low as a share of deposits. Now, we talked about that subdued loan demand in the first quarter. Does that continue, Jonathan Tice, into Q2, Q3?
Yeah, well, I mean, we know that the behaviour of the corporates and retail last year has ramped up deposits, and credit cards and loan facilities have been paid down. So that will continue to be a function of how quickly things rebound. But if you look at HSBC in the UK today, actually some pretty good numbers. So it'll take a while, but I would expect normalisation to happen over the next 2 to 3 quarters.
Jonathan Tice of Bloomberg Intelligence, thank you, sir. Tom Keene, a story as old as time, the difference between what is happening with the European banks and the American banks. And didn't Archegos just capture that almost perfectly over the last month?
Well, it was an accident along the way, and you're right, John, to bring it up and the 10 billion number and all that. But to me, it just comes up to how do you compete away from this easy crutch that we see right now, which is everyone's going into wealth management. John, who is not going into wealth management?
Tom, the issue, though, that you've brought up again and again repeatedly over the last couple of weeks, and it's for you to say yourself, but from what I see, from what I hear from you, is that you think this is an attitude problem.
Yeah, absolutely. Europe. 100%. Sorry, it's cultural, it's attitude. They're comfortable doing what they're doing, and they're bathing in their comfort, and you get into trouble.
So when does that change? And why hasn't that changed? David Herro, who's had that position over at Credit Suisse, has been waiting for that culture change for a long time. Tidjane Thiam couldn't get it done.
We've had the conversations at Davos, people looking for a change, whether it's cross-border or within nations, and it just hasn't happened. I go back to Fortis long ago and far away. There's not enough Fortises going on.
Lisa, final word?
There is a tension here. How do you make money? How do you take the risk you need to take in a negative yielding environment, which is all of Europe, in order to do so without necessarily suffering the consequences? And this tension keeps getting borne out and will keep doing so if they want to just make more money.
I remember a line from President Draghi many years ago when he said rates had to be low now so they could be higher in the future. I think rates are lower now than they were then.
There you go.
And they're not going up for a long time. James Bevan of CCLA will be joining us in just a moment. It's coming up on Friday at 1 p.m. Eastern.
Everyone will be wearing Crocs.
I'm trying to start recording that. I'd like to record that as we get to the summer months at, I don't know, 10:30 Eastern.
I don't know.
Would that work?
Maybe I should try Crocs.
Yeah, I'd love that too, Tom. This is Bloomberg.
We just can't catch up after going through a depressionary bust with this health crisis to suddenly having a runaway bull market.
We know this economic data is great. This is all reopening, fiscal stimulus. Well, how much does behavior change? We're all becoming behavioral scientists.
Ultimately, what we have to figure out here is, are we heading into a period of peak data? And peak data historically has been met with corrections.
All eyes really are on what constitutes substantial progress right now.
The good news is long-term, big picture, the Fed has a long track record of controlling inflation, but it could come at a cost.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene, a simulcast. Bloomberg Radio, good morning. Bloomberg Television, good morning. In the heart of earnings season, more earnings at 7, now further earnings at 8. But, John, we all await Microsoft today to see what big technology does across this nation.
Then on to Apple tomorrow, then on to Amazon this coming Thursday, and that's where the earnings growth has been for a long, long time. Tom, the story's changed, though. It's about the year-on-year base effects, and the base effects for the big tech players, a little bit more complex than, say, the base effects for some of the cyclical companies. But the story for me has been repeated by Morgan Stanley. Demand is good. Can we meet it with supply? Can we execute? And it's the execution risk that gets a little bit more interesting in the weeks to come as these numbers pour in.
And what's so important about these numbers, John, is what we saw with Apple yesterday. It's two Americas. There's this America almost guilty from their prosperity, and another America in this natural disaster flat on its back.
Political risk. Political risk around wages, political risk around the taxes you pay. And these companies want to put themselves out front as part of the solution. Part of the solution before anyone concludes they're part of the problem and does something about it. I think Washington, D.C., parts of it, Tom, have already made their mind up that they're part of the problem and they want to do something about it. And the Federal Reserve is doing its bit to keep things loose for a long, long time, while this government, this administration is going to start doing its bit a whole lot more too.
And the president with the speech and Jerome Powell with the speech at his press conference tomorrow. Lisa, I think one of the observations you've had in this stew of politics is simply the labor shortage that is here right now. We're hearing about that in earnings releases.
And how does that translate into persistent wage growth, right? I mean, basically people say it's here, this is for you, Tom, transitory. And they've continued to say that with respect to all of the inflationary pressures. But going forward, is this going to be transitory, especially if there isn't a change in the immigration policy, John? That is for you, in order to get people here to work for some of these companies that are seeing labor shortages.
Any excuse to let him have another drink. Any excuse.
I mean,
it's the issue right now, and I'm with you, Lisa. I really am. Is it transitory? Is it persistent? How persistent will it be? You like that?
Just keep saying it, yeah.
Is it transitory? Is it persistent? I love doing this. But that is the issue right now for the Federal Reserve too. Can we meet that demand with supply? And to what degree has the entitlement spending, the fiscal effort, held back that supply, just choked things off a little bit? And when do we start to bite into that in the months to come too?
And then the other thing is to have the courage to be in this. Let's get through the data. And we've got a wonderful guest to begin here on the courage to be in the equity market, given all of the transitory themes we speak of. John, help me out here. I've got green on the screen. I mean, I'm sorry, it's an equity market with a bid.
Yeah, equity's doing okay, Tom. Up almost 1/10%. The S&P 41.83.
VIX under 17.
By about a basis point, 157.92 on 10s. And euro-dollar just totally unchanged, 120.86. And I think Lisa mentioned something additionally this morning. In addition to all the great things that Lisa talks about, is just the lack of response in this equity market to some of the big beats so far that we've seen. And I can say safely that UPS isn't one of those names this morning, which has delivered some really nice numbers and is absolutely charging on, Tom, higher in the free market.
John, a story for May. I want to get to it right now. That's what we do at Bloomberg Surveillance, and you see it in the London Metals Exchange, the LME. John and I adore it. I particularly adore their annual convention that they have in London at the Dorchester. And John, I'm sorry, copper 10,000 is cause for celebration.
The highest since March 2011 for copper. That story continues. Higher prices, the miners are doing better off it, a better demand outlook, and tighter supply may be the issue there too. I want to bring in James Bevan of CCLA, the Chief Investment Officer. James, do you like the miners right now in Europe?
John, I absolutely do. I think there are some great quality opportunities. And what I would observe, interestingly, is that the ratio between the copper price and the gold price suggests to me that 10-year US Treasury yield should now be at around 2.5%. Now, we know it's not there, principally because Japanese investors have been buying, facing almost zero yields within their own market. But I would have a side bet with you that we will see the 10-year yield at 2% by the end of the calendar year. And that's a relatively big move, given that we only got through 1% on the first trading day of the current calendar year.
Is that a move that looks like the move we saw in Q1, a move that's accompanied by better banks, better bank stock performance, better cyclical performance, better small cap performance? Do the cyclicals perform in line with that move higher on 2s, on 10s, 2-2?
Johnny, I don't think they do. I think the banks again have a very difficult time. I would observe that the banks are now awash with overnight deposits. That's extremely bad news for banks seeking to lend on. What they want are time deposits. They want long-term deposits. They don't want all the hot money. And I think, therefore, that the banks have had their day in the sun. I would only, in the case of the States, want to be invested in JP Morgan and Bank of America, both of which I think have excellent opportunity to cut costs to support long-term returns. The middle ranking banks, however, are going to really struggle. And that, I would say, is going to be one of the challenges for cyclicals writ large. They discount a lot of bad news. When I'm looking at cyclicals today, I'm looking at the better quality defensive cyclicals, so some of the telecommunication companies, and some of the drinks companies like Diageo, which I still think looks too cheap.
James Bevan, I want you to rationalize 35 times earnings. One estimate of Microsoft is the 12 months forward view is 35 times earnings. Justify owning Microsoft right now.
Let me rationalize it by talking about the earnings yield rather than the price earnings multiple. Because, of course, the earnings yield is the price earnings multiple reversed. And an earnings yield of 3% needs to be considered in the context of where cash rates currently are. The equity risk premium payment for taking equity risk relative to cash as the risk-free rate of return does remain relatively elevated. And that puts all of the focus on whether or not we are going to get real growth. And I am in the camp that says we will get a short-term acceleration in inflation. That seems to be absolutely baked in the cake. Nothing we can do to stop that. But I do also believe that inflation is going to come down again. And I would say that that is driven by the demographic changes, disruptive technologies, high levels of embedded indebtedness, and the continuing globalization, and notwithstanding the trade tensions, does mean that there is a lid put on the capacity for domestic businesses to raise costs and prices generally. And that allows me to believe that a 3% earnings yield coupled with long-term growth still leaves a company like Microsoft offering premium returns to corporate debt and also very much to government debt.
If you're listening to markets, though, James, I'm looking right now at earnings that have beaten expectations by 26%, 11% if you strip out financials versus the average of 5% during earnings seasons. This from UBS's Mark Heffley. How do you explain the fact that you have not seen a cheer from equity traders? You haven't seen this excitement about this growth that's beating expectations in what is expected to be a low-rate world for a long time because of what you just said?
Lisa, I think that one of the problems we have with earnings numbers is the year-on-year comparisons are flattered by the extraordinary downdraft that we saw in March and April last year. And what investors are looking at is the trend growth rather than the one-off growth for the period. And looking forward, I think that we are going to see well over $180 of earnings for the S&P 500. That allows me to project that index will stand at 4,300 points by the end of this year. And my greater concern is we get to that level earlier on the back of this extraordinary liquidity environment engineered by the Federal Reserve and Treasury. And that would be the moment to take money off the table. But for now, I think that index earnings on trend are going well. I think the year-on-year comparisons are therefore going to be ignored.
James, it's good to see you. Good to catch up, as always. Thank you, mate. James Bevan, CCLA Chief Investment Officer. I want to turn to the automakers just quickly. Tesla down by about 1.83% in the pre-market. A conversation on this programme through much of this morning about better demand and can we meet that with supply. Have a look at the supply of inventory over at Tesla. Tom, they're down to 8 days of supply of inventory over at Tesla. Things are getting tight for some of the automakers, and that's just one right now. They've been able to meet the demand. They've done okay with the chip shortage. Others, it won't be the same story.
I'm glad you bring it up, John, because with JP Morgan's wonderful weekend note, their Friday note, thank you, Michael Ferroli, buried in there is a real discussion of inventories and the dynamics of inventories. It's a little bit inside baseball, but, John, it has a lot to do with how you get GDP estimates ratcheting upwards, and that's what we're seeing right now.
A monster inventory build, at least that's the effort, Lisa.
Yeah, the idea here is that you're going to see these chip shortages, which are so crucial to a lot of the automakers, persist for a significant period of time. A number of chip makers have come out and said that it's going to be years before it's resolved. How do they get that backlog of inventory when all the other automakers are looking for the same types of materials, especially in the electric vehicle space, John?
And do we stay with these elevated inventory levels, Tom? Is that something more persistent after the experience of last year? We've been conditioned by that.
John, that's the money question right now. The word stay, what do we do Q3, Q4, and then the whole worry into how you structure the next year. Granted, that's the wall of worry the market's climbing right now.
What do you think, Lisa? Do you think that's persistent?
A lot of people who I've spoken to in the supply chain world say yes, and that's because of the just-in-time delivery demand that you've seen. Because people go to what is most convenient increasingly, and the only way you can be convenient is if you have the goods to deliver in real time. So yes, a lot of people think that will persist.
What a fascinating time for the global economy. Full coverage continues right here live on Bloomberg TV and radio alongside Tom Keene, Lisa Abramowicz and Jonathan Ferro. This is Bloomberg Surveillance, and here is your price action. Up around about 5 points on the S&P 500. Futures advancing a little more than 0.1%. Into the bond market with yields higher, up a basis point or two, 158.27 on 10s, a 7-year auction. A little bit later, some supply in about 5 hours' time. In the FX market, euro dollar 120.83, totally unchanged on the day. Last week, it was the ECB. This week is the Federal Reserve. The 2-day meeting kicks off today, concludes tomorrow. For our audience worldwide, from a beautiful New York City where the weather continues to warm up, I think it peaks tomorrow, Tom. We call it 27 degrees. What do you call that?
We call that transitory.
You call that transitory. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden's proposal to boost the capital gains tax would hit individuals earning $1 million and married couples jointly earning the same amount. The president is set to unveil his plan tomorrow. It would almost double the capital gains rate for some taxpayers. In China, Bloomberg's learned that Hurong Asset Management has repaid an offshore bond with funds provided by the nation's largest state-owned bank. It's a sign that Chinese lenders are heeding government calls to support the embattled, distressed debt manager. Hurong has more than $20 billion of offshore notes outstanding. General Electric burned more cash than expected in the first quarter. That's crimped CEO Larry Culp's turnaround push after signs of improvement. GE's earnings did beat estimates. Still, Culp sees a difficult environment for the crown jewel of GE's industrial business. That's, of course, GE Aviation. And U.S. companies face soaring bills for all kinds of materials that they need to do business, and rising demand is helping them pass on those costs to customers. In earnings calls, executives from businesses ranging from Chipotle to appliance maker Whirlpool have outlined price hikes. Their comments back up the data that show inflationary pressures building in the economy. More troubles for British Prime Minister Boris Johnson. Allegations of sleaze and incompetence in his government have picked up. Johnson denied a claim that he had said he would rather see bodies pile up than order a third pandemic shutdown, despite multiple reports. Meanwhile, ITV reports that the Conservative Party had loaned Johnson the money to refurbish his government residence, a highly unusual arrangement. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
We have too much pressure on public companies, and we don't ask the rest of society moving on. We are going to put our public companies at a disadvantage. And then more importantly, though, we're not going to get to a net zero. The only way we can change that is getting all of society behind it, not just the few, the thousands of public companies.
Larry Fink there, the BlackRock chairman and CEO. From New York City this morning, good morning. Be sure to stay with Bloomberg for more from the Bloomberg Green Summit. We'll hear from Canadian Prime Minister Justin Trudeau, the former Bank of England Governor Mark Carney, and Blackstone global co-head of real estate Kathleen McCarthy. Looking forward to that a little bit later this morning. From New York, alongside Lisa, Tom, I'm Jonathan Ferro. Your equity market looks like this. An hour and 12 minutes away from the opening bell. Equity futures on the S&P 500 slightly positive, up a little more more than 0.1%. Yield slightly higher, up around about 2 basis points to 158.45. And euro dollar, 120.87, Tom. Muted price action in foreign exchange on a euro.
Yeah, the market's churning here. Maybe we'll see something tomorrow. Look for our Fed coverage tomorrow afternoon as well. But most people looking forward to the June meeting. Right now on the president's speech on infrastructure, John Lieber joins us with Eurasia Group in his important experience with Senator McConnell in Kentucky. John, I want to go down to the reality, which I'm sure you faced years ago with Senator McConnell, which is a bridge over the Ohio River. It is the Brent Spence Bridge, and it says all about how we can't fix our infrastructure in America. How do we fix the Brent Spence Bridge, given the president's initiative?
Yeah, that's a great example of a really important piece of interstate of infrastructure that carries quite a bit of interstate commerce and should be a pressing national issue that Congress wants to try to fix. That's really gone neglected for far too long. So, I think the reality is Biden's got the partisan alignment he needs to pass a very large infrastructure bill. One of the biggest challenges of the last 10 years has been the declining revenues into the Highway Trust Fund. That's made paying for these type of repairs extremely difficult. But right now, we're in an environment where the Democrats are basically united around increasing taxes on corporations and wealthy Americans to get this stuff done. And probably by the end of the year, they're going to have the authority to start the money flowing over the next 5 to 10 years to fix these kind of things.
Do you look for a compromise that focuses on projects like the Brent Spence Bridge, or are we going to look for a more omnibus bill?
I'd be surprised to see Republicans even being really relevant in this process, frankly. I think that they have, the Democrats have the votes probably to do most of the infrastructure projects. They've got big ambitions beyond physical infrastructure with this human infrastructure side, focused on childcare and subsidies for education and healthcare. And, Republicans just aren't going to play ball for that. And most importantly, they don't want to raise taxes to pay for it. And that's going to be the biggest stumbling block, I think, that makes this basically a partisan exercise.
And I want to go a little bit deeper into that, given your work with Senate Majority Leader Mitch McConnell, or former Senate Majority Leader. There is a question of whether they would be open, the Republicans, to any tax hikes. When you were working for him, did he talk about the necessity for paying for different projects, or did he believe that things would pay for themselves if you had the right projects?
I think I'd say that the kind of your average Republican member, believes in the user pay notion when it comes to infrastructure. So for a long time, that user pay idea was embodied in the Highway Trust Fund, where gas tax fueled the Highway Trust Fund, and then the Highway Trust Fund was used to pay for surface transportation projects. And now you've got people driving less, cars becoming more fuel efficient, and the gas tax hasn't gone up in a generation. So those revenues are declining. But if you ask, your average Republican if they want to raise taxes on American corporations or a small business owner to pay for infrastructure, the answer is going to be no. And this dynamic is just making it really difficult to get anything done.
Given your experience in Washington, D.C., does a $900 billion skinny infrastructure bill, and it is funny that we're calling a $900 billion plan skinny, does it seem feasible and likely to be the outcome of some of these negotiations?
Yeah, you raise a good point. I mean, it's absolutely wild. 2 years ago, the Senate committee that deals with infrastructure put together a bipartisan bill that was around $400 billion, and it was considered a historic achievement. And now many of the Democrats that were involved in that process basically rolled their eyes at the Republican $600 billion proposal. And it just shows you how far the goalposts have moved. But no, I think the challenge here is the House. And that even if there were a Senate compromise that ended up around $900 billion, which I'm extremely skeptical of that, the House senses an opportunity here, and Joe Biden senses an opportunity here to go much, much bigger in a way that's going to be really transformative for America's anti-poverty programs and really change the game when it comes to green energy incentives. And that's really what this is about. This isn't about repairing potholes, fixing the Brent Spence Bridge, and doing a couple projects on infrastructure. This is about doing big things to accomplish the Biden agenda. It's why he ran. It's why they think it's why he won. Mm-hmm. And that's their goal.
How does the big things tone fold into the beginning of the run to November of 2022?
Well, November of 22 is an interesting year. I mean, the party in power almost always loses seats, really always. I mean, there's very few exceptions to this rule that the party in power loses seats in the midterms. It's possible this cycle is a little different because of the fact that Biden didn't have any coattails. So it isn't like the Democrats have extra members in the House as some majorities do. But, the odds are, and the historical trend would be, that the Democrats lose probably the House and potentially the Senate as well, which means that Biden, like Obama and Trump, is going to lose his ability to do any legislation after his first 2 years. So if you think that your elect came to Washington to get things done, this is your window to do it as a Democrat. And I think ultimately that drives them to a partisan deal by the end of the year.
John, it's good to see you. Good to hear from you. John Lieber there, Eurasia Group. And Tom, on that final issue there, let's just build on that a little bit more. Will there be some payback? Because some people within the electorate in this country, many people, in fact, believe there's been some overreach beyond the mandate that it was given with such a skinny margin in both chambers.
Oh, that's a mystery. John, there's no question that is, if you will, the zeitgeist through the end of this year. But you're going to get into primary season, and that's going to have its own battle. But I'm fascinated where that payback is, John, in the summer of next year.
Lisa,
I don't think anybody knows.
Tom, you said it in early November, the midterms. The race for that starts right now, and it continues, Lisa.
The biggest unknown in my mind is what the economy is going to do. I mean, that feels so far away. And right now, Biden has a lot of popular support, as per that poll that came out over the weekend. But going forward, I mean, talk about the labor market. Can we get back down to some of the lows that we saw pre-pandemic? Can we get inflation that is big enough to potentially offset the debt, but not too big to make it difficult for people to buy things? We just don't know, John. We
could have a four handle on unemployment year end. Great news. But the cost situation, soybeans, wheat, fresh 8-year highs, copper, decade highs. The Larry Summers argument, I think we all know it well by now, Tom, that there's going to be some difficulties with inflation maybe. And that will be the experience that people have, regardless of what the Fed tells you. Everyday people aren't going to tune into the Fed tomorrow. I know you'd like them to. They're not going to. It's about what they experience month on month, Tom.
What? There's a Fed special coming up. That's what we're going to be doing, and he's promoting that.
Just crushed me.
I think you killed the Fed special yesterday. You think that I did?
People will tune in, find out about inflation. Coming up.
Tom,
Caroline Hyde is in tears.
I'm in tears with the way this is going. Equities up 6 on the S&P. This is Bloomberg. Live from New York City for our audience worldwide on TV and radio. Here's the price action on Bloomberg Surveillance. Equity futures grinding higher on the S&P by almost 5 points, up a little more than 0.1%. On the Russell, we advanced by about 1/3%. Morgan Stanley brought this up in the last couple of weeks, and it's becoming to be the story at the moment. Execution risk. Execution risk, execution risk. Demand is good in this economy. In America, can supply meet it? I think Tesla gave us a little flavour of that. Inventories starting to tighten up, a chip shortage. If the demand's there and you can't meet it, what have you got? You've got an execution problem. And that's what Morgan Stanley's getting at. We'll see a lot more of that in the weeks to come. Switch up the board and get to the bond market. 2s, 10s, 30s, 7s. $62 billion worth coming a little bit later from the Treasury. Supply of a maturity that caused a bit of a problem a couple of months back. Will we see the same story again? It's a different market environment, but who on earth knows right now? Your 10-year, 158.27. Your 30-year, about 226 to 225.60. Want to finish on euro dollar? Switch up the board and we'll get to the euro. A 121 handle Friday, Monday, briefly. Tuesday, 120.82, and totally unchanged. Totally unchanged on euro dollar, really muted going into the Fed tomorrow, Tom.
Huge stasis, even Turkish lira comes in, stronger Turkish lira this morning. Right now, our conversation of the day, John and Lisa, on economics. Peter Hooper joins us, of course, with Deutsche Bank. His deck on economics, hugely anticipated on Wall Street. Peter, I want to go to the heart and soul of your must-read, and that is simply you look for upside risk to GDP and an unemployment rate that drives us down to a fully employed America. Balance that for us right now. Will that occur within market stability and national stability?
Tom, that could be a tall order, but look, there's an awful lot driving growth at this point. We have, of course, the normalization of demand coming out of COVID as people are being vaccinated. We have tremendous fiscal support both behind us and ahead of us here. We think that we'll probably get at least a half a percentage point out of GDP out of what's still to come. But the household income support that we've gotten so far, building up a war chest of household saving that's going to get to something like 10% of GDP, waiting in the wings to be spent. There's no way we're going to see less than 6-7% growth this year. Our own forecast is above consensus at 7.5%. So that's certainly enough to get the labor market by second half of next year back down to the 3.5% unemployment rate that we saw pre-crisis.
In the dynamics that Matthew Lazzetti worked through for you, you coin a phrase, and you talk about the Amazonization, I hope I got that right, the Amazonization of the American economy. Do we underestimate the cardboard boxes and the cloud that's out there from Mr. Bezos?
Well, I mean, the good thing, Amazonization has a number of facets, but one very important for the Fed is despite this very rapid growth and a tightening of the labor market, unlike what we've seen for quite some time, Amazonization is a factor that we think is going to keep inflation from getting out of control. Certainly, the vast improvement in information flow about supply and demand of all kinds of commodities and services, price information now globally is going to keep, we think, after some initial disruptions as bottlenecks appear during this normalization process, Amazonization working in the background is certainly going to be there.
Well, but Peter, even at Amazon, we're seeing the pressure in terms of labor shortages, having to offer higher wages to lure people there, not to mention the fact the effort of unionization. Wow, this is quite a day. Excuse me, but I do wonder
again.
Going
do you
forward.
Want us to count you in?
What?
3, 2, 1. You just restart it. Peter Hooper's gone. We'll just restart that. It's the power,
let's
the power
restart
of TV
this show.
and radio. You can go again, Lisa.
All
just
right.
Start again and we can talk about it right now.
There is a question about whether Amazon is going to face longer-lasting cost pressures for a longer period of time, John. I think that Peter hung up because he was just like, forget it. If you can't say Amazonization or unionization, then you might as well hang up.
I think there was a technology problem with the control room. I didn't mean hang up on Peter. Just meant start the segment again and let Lisa gather her words and get it together.
Flames.
We are going down in flames a little bit.
This is not transitory.
Clearly not. Look, pay back rather from pull forward, I think is a concept we need to get our teeth into just a little bit. We got a taste of that last week with Netflix. What about the other big players in the mix here? When we saw a huge acceleration of existing trends through the pandemic, Lisa, and I just wonder whether there will be some payback because of the pull forward beyond just the Netflixes of this world. I want to bring back in Peter Hooper. We've re-established that connection, the Deutsche Bank Global Head of Economic Research, and of course, Chief Economist too. Peter, great to catch up with you, sir. Let's just round things out with a couple of thoughts on this for the Federal Reserve at the moment. The difference between transitory and persistent. You know, we talk and joke all morning about this, and Tom has a drink because it's the drinking game we play, and I think Vice Chair Clarida joined in recently too. What is the difference for you? What defines that as the year goes on?
Okay, well, one thing the Fed's been wanting to see is a string of good information on the labor market. I think that's 4 or 5 months of something approaching 1 million on payrolls before they give us any indication they're going to be giving us a hint about tapering to come. There's another issue here is transitory versus persistent on inflation. Yes, we are going to get a bulge in price increases in the middle of this year as growth normalizes, as the economy normalizes. But another thing to keep in mind here, going back to this Amazonization, is we've been well above trend in consumption of goods. COVID meant people dropped back sharply on their demand for services. I think as things normalize, you're going to see a shift back towards services, and that means taking some of the pressure off the goods sector. So, yes, we're seeing a lot of shortages. Yes, we're going to see some real disruptions as these demand patterns shift and things normalize. But we've been encouraged by the extent to which labor supply in the hospitality sector, for example, has picked up. Hiring has picked up. There's an awful lot of unemployed people that need to get jobs still. So there'll be some disruption. We will see some transitory price increases, but our expectation is on inflation, which could get to 2.5% middle of this year, maybe a little higher. We'll be back 2 or below 2% by next year.
Yeah.
That's not a persistent problem.
Peter, what's the economic effect of higher taxes?
So, I mean, looking ahead at what we might get. Obviously, from listening to some of your earlier discussion, a lot of uncertainty about just what's going to go through Congress here. But if Biden gets his program, if we get this $2.25 trillion jobs plan with the corporate tax package to go with it, that's worth about 1%. I mean, assuming roughly 10% is of the spending comes in the first year and the tax program goes through as planned, we're seeing about a percentage point of GDP growth out of the spending side and roughly a 0.5 percentage point offset from tax increases. The total tax increase over the next year, something on the order of, by next year, something on the order of $90 billion, little less than 0.5% of GDP. So yes, I mean, there are all kinds of questions about what impacts the particular form of tax has across different parts of the corporate sector as well as households. But the broad view, macro view, is we're looking at something like overall a 0.5 percentage point stimulus to growth. Would be more if it weren't for this 0.5 point drag from the tax side.
You know, Tom, it just strikes me the degree of policy uncertainty right now for economists to factor in. You've got that $2.3 trillion stimulus plan that may or may not see the light of day, followed by a $1.5 trillion plan expected to be announced this week, followed by potentially tax hikes that could have a negative impact. How do you game this all out?
I think you game it out with 5 seats in the House come November of 2022. I would suggest, Lisa, the politics is going to take it over. Peter Hooper, you've got a 55-page deck, and there is one page which describes the foolishness of this all. It is stunning how the savings of this fiscal strategy has gone to the wealthy. It's absolutely a breathtaking chart. Folks, we protect the copyright. Go to Deutsche Bank to get the chart. Peter, how far apart are the two Americas right now?
Tom, they've obviously grown ever further apart, certainly over the last decade and accelerating over the last 4 years with tax cuts, and in the last year with the asset valuation, asset gains in stock and housing markets. So no question, politically, something's got to be done about this. It's going to be painful when it comes, but that is certainly one reason to be considering taxes more heavily at the upper income levels at this point going forward.
Peter, we've got to leave it there. Apologies about the technical problems. Peter Hooper there, Deutsche Bank Global Head of Economic Research and Chief Economist. Coming up in the next hour on The Open on Bloomberg TV, Michael Collins, PGIM Senior Portfolio Manager, why they've been adding a little bit of duration here, just nibbling at the 10-year as we went towards 175 on a US 10-year maturity near the end of March. Looking forward to that chat a little bit later.
So that means they're looking for lower interest rates?
Potentially over time. And Tom, maybe Mike Collins bringing up a really good thought, interesting thought, maybe not good for many of you. The idea that maybe the Fed doesn't get away from zero, gets stuck down here because it waits too long. I think conceptually that's something to spend a little bit more time on, maybe later in the year into next year, but something to consider and something that Michael McKee tried to ask in the news conference in the last one.
Got slammed.
And I think they played elevator music over the top of him.
They did.
And Chairman Powell didn't really respond.
Yes, that is accurate. To me, John, what's fascinating about this is everybody's calling for higher inflation. That has all my radar up.
Yep, and you see it in the research and you hear it on the corporate calls as well. This earnings season, Microsoft later, Apple tomorrow, Amazon after that, the Federal Reserve with a decision in between. And I'm told, absolutely stellar, captivating coverage coming up on TV and radio.
Got that right.
Led by Tom Keene and Caroline Hyde and Scarlett Fu making an appearance too, I believe. So looking forward to the coverage tomorrow afternoon. Equity futures up 4 on the S&P. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden will propose a large-scale tax increase tomorrow. He'll also call for giving billions more to the IRS to make sure the rich people and large corporations pay all that they owe. Bloomberg's learned that the proposal would raise the top tax rate to 39.6% for those making at least $400,000. The measure's a key element in the president's American Families Plan that he'll unveil tomorrow. President Biden is stepping up pandemic assistance to the rest of the world. The U.S. will share its entire supply of AstraZeneca's coronavirus vaccine with other countries. Plus, it's putting together an aid package for India. All this represents a shift for President Biden. He's been focused on making sure Americans are getting the vaccination first. And Vice President Kamala Harris has pledged an extra $310 million in humanitarian aid to stem a wave of migration from Central America. The money will go to Guatemala, Honduras, and El Salvador. Harris discussed the need for long-term economic growth in a virtual meeting with Guatemala's president. BP is trying to win back shareholders after what's been a difficult year. The British energy company says it will begin share buybacks after what it called exceptional natural gas trading boosted earnings. BP cut its dividend in half last year. Now it plans to return at least 60% of surplus cash flow to shareholders. Eli Lilly has cut its annual forecast for annual earnings per share. That's after the government cancelled an order for the company's coronavirus antibody. Instead, the agreement now focuses on Lilly's combination treatment. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
The sector right now that is telling the most interesting story is consumer staples. Staples are at their lowest relative point versus the S&P we've seen at any point over the last several years. I think the weakness, the relative weakness in staples, the relative weakness in utilities suggests that bond yields probably don't go a ton lower from here.
Christopher Verone, strategist, head of technical strategy there with us earlier today. Lisa Abramowicz and Tom Keene. John Farrell prepares to drive forward the conversation at 9 a.m. Barry Ritholtz with us right now, Bloomberg opinion columnist. And Barry, I really want to go to what the debate over capital gains tax is obscuring. You and I have a collective memory, and I really give a shout out to Visualizing Economics for a memory of the 1960s when we had multiple brackets, and the top bracket was 70, 80, even near 90%, almost European-like. Are we going back to higher brackets and sustained brackets for the haves?
Well, it certainly looks like that. I think the focus on the 40% number is a little bit of misdirection. What we really have going on is the creation of a brand new top tier in terms of taxes for the wealthiest 1%. And so in some ways, that's a throwback to the pre-Reagan era. Yeah, absolutely.
Yeah, well, okay, it's a throwback to the 60s as well. What you and I remember is 5-for-1 coal deals, commercial aircraft equipment leasing deals where there was a cottage industry to avoid the agony. Why aren't we going to see that again?
Well, the devil's in the details. It really depends on how the tax code is drafted. Keep in mind, back in those days, all those crazy, tax dodges looked at the existing tax code and said, okay, what can we do to hide legitimately this income from Uncle Sam? And so, incentives matter. When you leave an incentive for people to engage in that sort of lease buyback nonsense, the funny thing about it is lots of companies decided, hey, why do I need to own my building or my office? I might as well do a lease buyback and get it off my books after the tax code changed. So how it's drafted makes a big difference. The incentives involved make a big difference. And if this is carefully crafted without a lot of room for loopholes, well, the expectation is raising taxes on the wealthiest real estate and stock owners is going to generate more income. That'll pay for infrastructure that everybody gets to enjoy.
Barry, how much will this change investment strategies, investing perhaps in more munis or other more tax-protected investments?
It depends on what they do with the short-term rates. I haven't really seen where that wants to go, but there's always been a penalty for traders. If you're looking at Robinhood and those sorts of things, lots of those traders were surprised at how high the higher tax rate is. So you can't, the short-term tax rate at 30%. Obviously, you can't have your top 1% long-term taxable rate higher than the short-term rate. So there's going to have to be an adjustment there as well. If you're a long-term investor, I don't think there's a whole lot you're going to do to adjust your portfolio. If you're living on dividends, if you're living on income distributions, well, maybe it might tilt the scale towards munis and other income producers. But for the average person with an IRA or a 401k who are saving for retirement, it wouldn't make any difference because it's going to be in a tax-deferred account. Maybe it shifts some people more aggressively towards Roth rather than traditional. But most savers are tax-deferred.
Barry, in addition to being star of stage and screen and audio and print, you also help people manage money. And there is a question of how seriously to take some of the proposals that have been put out there in terms of higher taxes, as well as in terms of some of the infrastructure spending. How do you game out policy proposals in Washington, D.C. when it comes to how much you might make, whether it's in the stock market as a result of people selling ahead of taxes, or whether it has to do with gains due to infrastructure spending?
So the first level, I love that question. The first level of that analysis is assume 98% of what gets floated won't get passed. A lot of these things are rough ideas and outlines, and sometimes there's pushback. So you can't start flipping your portfolio every time something comes out of DC. 9 things a day come out, and you're best ignoring all of them. However, when there's a groundswell, such as there has been in terms of pushback to wealth and income inequality, and when there is an overwhelming demand, as there is for bringing our infrastructure, forget 21st century, I would just like a late 20th century infrastructure in America would be a huge improvement. There's an increasing possibility that something will get passed. My best guess is 40% is DOA, but you currently have 3 tiers of capital gains. 0 if you're making less than 80,000 if married, or 45,000 and change if you're single. 15% above that, below about 400 and change, and anything over 400 is 20. There is a balance symmetry to 15, 20, 25%. So I think 40% is just an opening gambit, and it will end up closer to a 25% number than a 40% number. P.S. if it's 25%, you still have carried interest as a loophole out there. It would make sense with this proposal to close that loophole. At 40%, carried interest essentially becomes ordinary income cap gains. It becomes the same thing for hedge funds, private equity, venture capitalists. If they take the rate, let's call it 25%, then that carried interest loophole would have to get closed as well.
Got to leave it there. Barry Ritholtz, thank you so much. Tax analysis, and look for that from his work at Bloomberg Opinion. Lisa, your thoughts here as we dive into earnings season and Microsoft this afternoon.
The idea here that a lot of companies have beat substantially, and the response has been, what are you going to do for me next week? I mean, basically, traders haven't been responding to that.
I don't disagree, yeah.
I am curious, and to go to James Bevan's point, he's saying, look, in a low-yield environment, the earnings yield on these companies looks that much more attractive, even if it's lower than it has been historically. And that, to me, is one of the tensions. Why is that not holding? Why is that not the story that we're hearing from traders following these earnings?
We call it earnings season, and I really wonder if we should call it revenue season, because companies that have higher single-digit revenue guesses forward, companies that deliver revenue growth seem to be doing okay. Look at UPS. But others, you're absolutely right. It's been a little more challenging than I expected.
It's just surprising the reaction to it, especially when you have the likes of consumer staples coming out, Coca-Cola, P&G, Procter & Gamble, coming out and saying, yeah, our input costs are rising. We're seeing inflation. It is real, but we can pass it on because our consumers are doing pretty well and you're seeing wages go up. Yeah. So when does that translate into a renewed push into equities? Yeah. I just don't know.
36-month, 3-year GDP for Deutsche Bank going out 3 years from now is 4.23%. That used to be called a boom economy in itself, but that's a distortion of where we are right now. Right now, our distortion markets, well, you know, not a snooze fest. It's extremely exciting into the 9 o'clock hour.
Way to
Red
sell that
and green
forward.
on the screen.
Woo.
The VIX. Let me give the
Fairly
Dow
red.
because Ferro won't mention the Dow.
Fairly green.
33,859 on the Dow, down 18 points. Microsoft and the Dow this afternoon. This is Bloomberg. Good morning.